So again,
Hmm.
it's not going to be what these companies report. It's going to be about what they say about the rest of this year. And if their guidance, so two things are potentially, and so here's two of the potential risks. We talked about those earnings being very optimistic for this year. If we go through this quarter's earnings season and outlooks are starting to get cut back, we're going to see those earnings estimates drop. And that's going to make valuations more difficult to justify at current levels. So that may induce some more risk into the markets worth paying attention to. If
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. I'm very excited to welcome you all here at the end of the week for another weekly market recap featuring my good friend, the Argentine portfolio manager, Lance Roberts. Lance, how you doing?
I am not in Argentina, I'm in Houston.
Yeah.
So
Well, folks may know Argentine is a derivative of argentum, Latin word for silver. And right before we hopped on here, Lance,
uh-huh.
silver finally cracked $100 an ounce. So we got a
Yes.
lot of celebration going on. We'll talk a little bit about that, both to celebrate the win, but also to urge a little bit of caution here. But anyways, for everybody who has followed the silver ride, especially those of you who got in, 6 months ago, went back when it was 35, or 6 years ago when it was much lower than that. Congratulations to you all. Um, but yeah, it's a great day for anybody who's got any interest in silver.
Yeah.
And Lance, it raises the question. So what do you think is going to be hit next? 5,000 gold or 7,000 S&P? Because we're very close to both.
Yeah, no, look, all asset classes are running right now, and it's great. I mean, pretty much, as we talked about before, you can pretty much throw money into anything and it makes you money. And I love markets like that. It makes it really, really easy to make money. And since that's what we're in the business of doing, right? That's why we all invest is to make money. This has been a great, such an easy market over the last few years to generate really outsized returns. I don't know how long it lasts. That's kind of the theme of today's article, which is called the South Park market.
Yeah, we're going to
But
get to that.
yeah, yeah, but it's man, enjoy it. It's so easy, just I encourage you though, just to be a little bit mindful about managing risk and just take some profits along the way. These prices aren't going to last forever. These things eventually always reverse, and doesn't matter what asset class it is, you're going to have a reversion in price at some point. So just don't forget to take some profits along the way and manage your risk. But yeah, it's great.
All right, so we're going to get into all of that. First, let me just congratulate you and the entire team at REA. You guys put on a wonderful conference last weekend, and I was out there for it. Had a great
Yeah,
time. And from what the audience told me, they did as well. A few things I want to talk with you about that, but you, Michael, and I did kind of a live weekly
yeah.
market recap there on the stage to conclude it. And I was kind of digging around with you around the nature of this market and sort of finally got to the type of answer I was looking for from you, which was sort of given the arc of your long career in this space, how are you looking at today's market? And I can't remember the exact words that you used, Lance, but you basically did say like, look, this is one of the most overvalued markets, if not the most overvalued market I've seen in my professional career. That was not a message to say everybody sell right now and get in the bunker, but I found that was very important to hear because yes, you're playing the market you have, you're dancing while the music's still playing, but you do have a caution in your head saying, look, I've been around for a long time and I've never seen things this deviated from their means.
Yeah, no, and again, when you look at that, and again, this is also if I have some charts and stuff that we can go into when we get into the article here in a minute, but um, look, when you see this type of market where stocks generally always kind of go up first, then it begins to drag every other asset class up with it. And that's because as money's made on one side of the ledger, then people start looking like, okay, here's the next opportunity. So I go buy this asset, and then kind of speculators move into that market, and that pulls those prices up, and then we find the next market, so forth and so on. And eventually that always, whether it was 1999, 2008, 1987, whatever, those always culminate in eventually a risk off event for whatever reason. And look, there's always a catalyst that causes that reversion in price, and we just don't know what that catalyst is going to be, whether it's going to be something credit related, economic related, whatever it is. And that doesn't mean today by any stretch of the imagination. Just because markets are overvalued does not mean that markets are going to crash. I'm actually writing an article about this in the next couple of weeks called the boy who cried wolf. And there's that old parable, Adam, about the young boys out in the sheep, tending the sheep, and he gets bored, so he runs in town screaming wolf, and there's no wolf. And so the everybody runs out there to defend the flock, and he does this a couple of times because he's bored. And then a wolf eventually shows up and nobody listens. And the reason that parable is important is that's the message from valuations. And one of the things that you and I have both seen over the last really kind of 3 years is that we've seen a lot of people come on to different media channels, exceptions like, oh, the markets are going to crash. Valuations are very high, and that always means markets are going to crash. And while there's truth to that statement, it doesn't happen immediately. And so when valuations are high and these messages come out and then nothing happens, we begin to ignore the risk. It's like, oh, this time's different. These asset prices are just going to go up forever because
Mhm.
there's a supply demand imbalance, or there's this reason, or there's that reason. But we ignore the risk because the risk haven't presented themselves. It's these markets just ignore all the risks, so everything's fine. It's different. But that's the trap that investors get themselves into. And so, yeah, eventually these valuations are going to matter. The price deviations in metals are going to matter. That supply demand imbalance is going to shift at some point. And there's going to be big reversions in all these asset classes back towards their means. And that's just what history tells you. Just take a look at any price chart of any asset class going back. They go up and they also go down. So what's important is just don't forget about that risk management in your portfolio. Be sure, remember, take profits, rebalance risk, reallocate capital to, other places. We just did that recently in our all-weather model. We just sold some silver just yesterday, as a matter of fact, and bought Bitcoin because Bitcoin is completely beaten up right now. It's very
Mhm.
oversold, starting to show some signs of life here a bit. So there's a good potential rotational setup where I can take an overvalued asset and go buy an undervalued asset and maintain that volatility ratio within my portfolio.
All right. So, very good point. Um, we're going to talk in more specific about your article in just a second, but just a couple things to react to there. One is I was literally just talking about this yesterday. My daughters are now getting older. I've got a daughter who's entering her mid 20s. I've got one who's 19, so she'll be 20 next. Um, they're nowhere near looking like they're going to get married anytime soon. But I'm already starting to think about grandkids. What it's going to be like, and was trying to think about what books would I want to give them, right? What would I want to what library would I want to build for them when they're young? And I was reflecting on one of the books I read a lot when I was a little kid, like 5 years old type of thing, and it was Aesop's Fables.
Yep.
And those are timeless stories, right? I mean, the stories are literally thousands of years old, right? I mean, I think a lot of them date from ancient Greece, and they're true. I mean, or they're truisms, and things like The Boy Who Cried Wolf, right? I mean, you learn the dangers of doing that, when you're young reading this. Same with The Ant and the Grasshopper, like a lot of kind of almost sort of like the financial values I think I developed, where the seeds were planted there with Aesop's Fables. So anyways, your story there about The Boy Who Cried Wolf resonated with me. But yeah, I feel badly. Like, I don't think I got that book for my girls when they were young. So hope to remedy that with the next generation. Um,
It's not too late. You
but
can buy it from now and have a night just reading fables.
yeah, well, maybe I'll do that. Like, why am I reading this
Sit them
children's book?
down over dinner and say, "Look, I forgot to do this when you were younger, so we're going to do it now." So
Yeah. Here, climb in my lap, and I'm going to read it to you. Yeah, make it as awkward as possible.
exactly.
Um, but to your point there on silver too, I just want to do a few things. And by the way, folks, you you'll be harder pressed to find somebody who has believed more in silver and still does. I actually think that silver price will go higher in the future. Just to Lance's point, the big question there is when and at what speed. And I think that the metal has just moved so far, so fast here that to expect it to continue its current trajectory, I don't think it's particularly realistic. And I think it's actually kind of gluttonous, right? I mean, you've been given a massive gift of, price appreciation that I think nobody expected 6 months ago. And just to expect that to continue, it's really not that realistic. And let me just show you what I'm talking about here. So here is the price trajectory of silver, right? Lance, these exponential slash vertical moves in any asset class, you strip the name silver off there. If I showed you this chart about any asset class, I think you would say, hey, look,
Yeah.
take some gains in that thing, buddy. This is not going to last forever, right?
No, no, that's right. Let me, if you don't mind, let me swap share you charts real quick because this is
Great.
one I was just looking at this morning.
All right. I'm going
Um,
to swap share back after you do that.
Yeah, that's completely fine. So here's a long-term chart of silver. This goes back to the late 1970s, and there's a couple of things to take away from this. First of all, just remember that silver is used in the production and manufacturing process, right? So, right now the big narrative behind silver is this supply-demand imbalance is that there's not enough supply of silver to meet the underlying demand. That's a true statement. Nothing wrong with that statement at all. Now, the question, though, is twofold. One, is the current price appreciation greater than the supply demand imbalance? In other words, is it overpriced relative to the supply demand imbalance? Or what happens when the supply increases? So, a couple of things that can increase supply, of course, is that when you have high prices, that certainly encourages miners to go out and extract more silver or more metals from their various assets, and maybe doing it in a more unprofitable way. So they're going to go drill more mines that were previously unprofitable or hard to get to are now worthwhile doing. So that will help increase supply. The other side of this is that we talk about inflation all the time. If you're buying an electric vehicle, and these are the big stories right now. Oh, it's the rise in the data centers, the EVs, the solar panels. Those all use a lot of silver. True statement. But that means that incremental cost into those products is rising sharply. And what happens is you get a fall off in the demand equation. Then all of a sudden, supply is able to catch up. So when supply and demand rebalance themselves, the price is going to become under scrutiny. And this is what's happened in the past. We've had supply demand imbalances before, and then the price runs up, and it can stay elevated for quite some time, as you can see in the chart. But when you're 6 standard deviations above, this is a monthly chart, by the way. So this is you're looking at the 200-month moving average, which is currently around $30 a share right now for
Wow.
silver. You know, and if you'll notice, the price has always reverted back to that 200-month moving average, in previous spikes. It always comes back to that level because that's where the economic balance is for silver historically. So when you start talking about a reversion to the mean, you're talking about a reversion from 100 back to 30. So now again, I'm not saying that's going to happen, but and when you're 6 standard deviations above your long-term means, that becomes more problematic in terms of what happens gravitationally. Because remember, the most important thing is this market, what you're looking at right now, this is not a function of physical demand at all. There is no physical demand input into those prices. This is all futures being traded on the New York Stock Exchange, on the New York Mercantile Exchange. It's just that this is large commercial speculators betting on the price move right now. And so when something ultimately reverses and they run those contracts in the other direction, that's why your reversals can be so sharp.
Yeah. And now, look, to your point about narratives, there's going to be a bunch of people watching, pushing back on this and saying, Lance, but you don't get this part, and it's different this time for this reason. The
Again,
honest answer is,
it's always different this time.
it is, and look, it could be. The honest answer is we just don't know. But you're
Yeah,
walking through the math, the statistical math here that you have to be you're fighting right now. If you're saying, look, it's not going to correct.
that's right.
Look, I'm still bullish. I actually think there are elements that wouldn't surprise me if it is different this time. But it's all about price and value, right? Which is okay. Well, what is given all that? What is the true price right now? I don't know. I mean, I think it's higher than it was, back at 35 back in June, but it's moved so far so fast. I am totally open to just the dynamics of price action to say, hey, look, things tend to get overheated way ahead of themselves. A chart like you just showed, that is an extreme of an extreme. And so I think to just be naked long here is, it's not responsible. Now, could silver still go a lot higher here? Absolutely. Like I said, I'm a big fan. I haven't sold any of my physical ounces. I'm not going to. I'm still in it for the long haul. But two things I just want to note. One is, folks may remember, I put on the silver laser eyes on my profile photo on X. And back when silver made its breakout above 35 back in June. So again, big fan of silver here. I think I was one of the first, if the only people to actually do this. And as a result, if you have followed me on this trade, congratulations. I'm only going to ask for 20% of your gains above $35 an ounce. You can send those to adam@thoughtfulmoney.com. But I am hanging up the silver laser eyes for exactly the reasons we're talking about here, Lance. They have totally done their job. I think to ask for more out of them, like I said, is not just unrealistic, but I think just downright gluttonous at this time. And I remember the Wall Street axiom that pigs get fat, but hogs get slaughtered. But I do want to take them out just for one last ride. So if you'll bear with me here, Lance, let me do that now.
Nice. Very nice. But you bring up an interesting point though, Adam, which is, so let me ask you a question. So you have a lot of physical silver. I get that, and that's great. But why would you not sell some of your physical silver here? And because we know historically prices going back to 1970 that this may be the highest price. You may get slightly higher prices in silver. Maybe you go to 120, maybe you go to 150,
Yeah.
maybe this is the case. But these are probably prices that you're not going to see again for 30 years. And so, and even if you expect silver prices to go higher, right? So there's an economic balance for metals, right? Their use in jewelry to the use in manufacturing. So there's a supply demand equation that'll work out there. So why wouldn't you sell some, not all, but sell some physical silver and look to buy it back at cheaper levels? Maybe that level's 50, maybe it's 40, maybe it's 30, maybe it's 60. But why wouldn't you sell some physical here and buy back physical later cheaper and
It's
capture that gain rather than just
it,
write it back down again?
it's a totally fair question. For me, there is a part of it. I know you're not going to like this word. I'm going to say in the debasement trade, and I don't mean in the sense of how it's just been used in the past couple months, but as you and I have talked over the years, everything we talk about is probabilities, Lance.
Mhm.
The thing that I have one of the highest probabilities, highest levels of confidence in is that the purchasing power of fiat currency is going to lose value over time, right?
Inflation, yes, of
Yeah. So
course.
I want to hold part of my assets in actually real, tangible, physical things whose intrinsic value can't be inflated away. Now, I know you're going to say, "Hey, look, let me show you the charts. Stocks have done better
But
than I'm
but
going
but
to."
you haven't solved that issue. You're still invested in dollars, even in silver. Because
Yeah, but
to spend, so if let's just say currency goes away, you've now got to spend, or let's say the world ends, as so to speak. But to spend that silver, you've got to convert it back into dollars. You can't go down to Starbucks and shave off a little smidge of silver and buy a cup of coffee.
well, if the world ends, yeah, you can. And I've got my junk silver where I can take out my little,
Mm.
Mercury dime and pay for something with that. But that's not really why I own it. I
Right.
don't spend a lot of
But no,
time.
my point is more fundamental. You're not going to get any younger, neither am I.
Yep.
And let's say the price reverts back to 30 for the next,
Right.
15,
30
20.
years. Do I have 30 years to wait on that?
Oh, yeah.
I don't.
And again, you sell some here, and again, you buy it cheaper. You're still not getting out of that trade. You're just managing, you're just taking some extremely insane profitability out of this, capturing that value. Your wealth has now increased. And then at some point down the road, I'm not saying sell it all either. I'm not saying haul all your silver down and sell it. We're still long silver and gold and uranium in our portfolios, but we're taking profits because
Right,
we
you're taking profits.
realize
Yeah. And just to be clear,
this is not
I'm
going to,
taking
this
I'm
is going to
taking
last.
I'm taking profits in paper physical
Sure,
exposure. So
sure.
it's not that I am taking some off the table and I am using hedges and I put a hedge on this
Yeah.
morning. against my physical silver part. So I'm not just going blindly long. And like I said, this isn't all of my wealth, right? And
Oh
so I
yeah,
want
yeah.
to hold some of my wealth in atoms, right? Not in paper claims, not in digital bits, right? Which and I do in other things. So
Right.
part of the answer there is just I'm holding it because I still believe in the long-term value. And to your point, Lance, let's say it's another 30-year cycle, and let's say I'm dead by then, right? Well, this is part of what goes on to my progeny, right?
Right.
Yeah,
And I guess the
it's not
question is,
all of
man,
my
what's the
wealth. I'm not completely tied to the mast on this
yeah,
one.
yeah. No, so that brings up an interesting point. So why would instead of holding a silver bar as an example, which is totally tied to the commodity, price driven by the futures market, why would you
Yeah.
not own numismatic valued coins instead? So in other words, buy coins that have a collectible value that's not tied necessarily to the commodity price because they hold an intrinsic value because of their rarity. Would that be a better way to store your wealth?
Yeah, I think that's not a bad question. Um, uh, One, you have to become an expert in this. So this is something that takes a fair amount of time, right? Because the numismatic world, like any sort of collectible world, there's a lot of scams out there. There's a lot of things that you can be oversold.
Yeah.
Part of that is I'm just, I've got lots of other things I'm spending time on. I don't necessarily want to become a numismatic expert. And I do feel
Well,
that
hopefully you have a trusted advisor for that. Like, I mean, somebody that is an
yeah,
expert.
you could get a coin guide, and like I said, that I would if somebody has that interest, absolutely, right? You've got an additional optionality value on your gold. You've got the underlying gold content, and you've got the collectability value. Um, yeah, no, I think it's fine. I do think for some of the people who are more worried about kind of end of the world type stuff, and that's why I'm holding gold, and I'm not really one of those guys. But I have thought like, well, in that case, the numismatic value kind of just goes away because nobody really cares about collectability. They've got a
You
bigger
better
pro.
have lead. You better have more lead than you've got silver at that point.
Yeah. And it was interesting. My father, for a time in his life, collected US currency. And
Mhm.
this is like old notes, like Continentals and early
Yeah.
forms of the dime. He really got into it. But I do remember, like, it took a lot of his time.
Well, yeah,
Um,
that's a hobby, right?
yeah, but I mean, like, he really had to get very well educated because there was a lot of kind of crap out there, shysters and people selling you, well, here's, this is why this thing is so valuable. And then you do the research. And my dad was probably somewhere on the spectrum, looking back in retrospect. And he would just do the work to finally be like, you know what, I actually think that's a bad deal. I've got way more other things that I'm trying to, I'm just right now still holding on my fingernails trying to get done in my life. So, but it's not a bad question. Yeah. And look, I think it's super fascinating. And I think I told a story. I think I told a story here about going to see one of the world's best mineral collections recently. And I mean, it's wicked cool when you see what an expert collector can build.
Yeah, yeah, absolutely. And no, it is. And again, I had an uncle that was a big, big coin dealer, and collector. And that was his passion in life. And he knew everything there was to know about every coin ever made. I mean, maybe you need to go out and buy pennies, the 2025 penny, since it's all going away now.
Right,
Maybe
before
in
they're all
30
gone.
years, I
Yeah.
guess that'll be the next big collectible, the last penny ever made.
Yeah, it is funny. I did I'd had a little penny collection when I was a kid, and with my older daughter, kind of gave it to her, and we continued building it when she was young. And yeah, when they decided they were going to cut the penny, I'm like, I think that collection has just all of a sudden gotten a lot more valuable.
Yeah.
A, because they're not making anymore, and B, because those old pennies are copper. Yeah, unless you've got the
Absolutely.
World War II penny that was steel for a little bit.
Oh yeah.
All right, but my point there was really just trying to underscore what you were saying, Lance, which is even a big silver bull like me is saying, look, we've had it so good for so long. Time to exercise some prudence here. Just the charts are suggesting that a pullback is quite likely. Not saying it's guaranteed, but again, when you're faced with those probabilities, just to be blindly long, to me doesn't seem like too much of a prudent strategy. You should have some
Yeah.
defenses in place. And of course, the simplest is just taking some chips off the table, right? As
Yeah.
Lance always tells us. But I did want to let folks know too that I had put on a hedge. This is not personal financial advice for you. So obviously you should talk to your professional financial advisor to see what might be right for you, given your current positions and all that stuff. But you know, I am putting some defense into the mix, although I still have a lot of offense on the field.
Yeah. Of course, and as you should. So again, like I said, we're still long our metals, and we're just doing a little bit of rotation in the portfolio, just keeping risk balance, and the portfolio is doing fantastic. That then
Right.
nothing wrong with that at all. So again, if we get a rotation in the markets, there's some things that we've been allocating some assets to over the last couple of months that should do extremely well.
All right. I want to, we'll get to that when we get to your trades about kind of what's on your target list. And it's interesting that you mentioned Bitcoin there. Real quick, just to get back to the conference for a second. There were a couple, Lance, it was actually a great event. And I took some good notes out of there that we'll talk about near the end of this. But for me, the most meaningful part of it was the vast number of, two things. The quality, the caliber of people who were there was just off the charts.
Yeah.
And it was so interesting. It was such a wide variety of people. I mean, we had people who were scientists, people who were doctors, people who were entrepreneurs, people who were, oil men. There was the woman there who was the actress slash producer. I mean, such a well-heeled and well-accomplished group of people. So again, congratulations to RIA for cultivating that type of following. But people were extremely generous in coming up. I think you got a fair amount of this too, but
Yeah.
coming up and just saying, how much they appreciated what we do and how much sort of this financial education has really helped them become more successful investors. And also to a certain extent, how people have really come to look forward to these conversations that we have here, Lance. One, to get educated about what's going on in the markets, but also just get some of the life advice that you don't really get elsewhere in the world. And I mentioned this briefly when we were on stage, but I had two quick stories to tell. One was the young gentleman who I think handed both you and I handwritten notes saying how
Mhm.
much he appreciated what we did. And of course, we're like,
Who does that?
who does that anymore? I mean, this kid was certainly raised right. His mom definitely needs to get some flowers in the mail. Um, but said some very nice, kind things. But he said, my wife really wanted, she pushed me to come to this conference because I follow you guys so closely, and she, when I listen to you guys every week, she asks me, "Oh, okay, you're gonna go listen to your boring guys now?"
Exactly.
And it's so funny because I think probably a lot of people watching probably have that same experience where the
Yeah.
time they're listening to us, their spouses maybe rolling their eyes a little bit, saying like, "Oh my God, you're listening to these guys just talk about money and riff on life, how boring." But somewhat in her and our defense, his wife, I think English was her second language, so maybe she doesn't, pick up a lot on the jargon that we use. So I can understand. But anyways, Lance, like I said on stage, I'm totally happy to be your boring wingman any day.
You and me both. This is one thing because that actually struck me, and I was thinking about that after the fact, which is, isn't it interesting, right? From the standpoint, we talk about this K-shaped economy. And if you really dig down into the K-shaped economy, yes, there's some bifurcation in the markets because of, things that happened, post the pandemic
The
shutdown. We
COVID.
sent
Yeah.
checks to households, those type of things. There's certainly some of that there, but there's a big chunk of that, issue. And when especially when you talk about the millennials and the Gen Z in particular, they're like this term financial nihilism has popped up over the last couple of years, which is complete nonsense.
Right.
But
Which is screw it, right? Like this,
yeah, just screw it. I'm just going to invest. I'm just going to take the most risk and all those type of things, which we all know, right? Turns out badly at the end of
right.
the day. And it's interesting that people find this subject so boring when outside of your marriage, probably finance is the most important thing in your life, right?
Yep.
If you get your finances under control, all the other problems take care of themselves. Home affordability takes care of itself. The ability to live whatever kind of lifestyle you want to live will take care of itself. But yet that's the thing. We don't want to listen to how economics is so boring, finance is so boring. It's just so fascinating to me because it's such an money is such an important component in our daily life, yet we pay literally no attention to it on the most part.
I know. And this, I mean, this could be a whole rant in and of itself, but this goes to the lack of financial literacy
Yeah.
in this country and in much of the West. And we've sort of I don't know if we told ourselves this or been convinced of this or whatever, but it's that it's mathy. Math is hard. I don't want to pay attention to it because it's hard, and I'll just let other people think about it, or what'll be is what'll be, and I'll just kind of keep my head down.
Yeah.
And obviously, we know no strategy is a terrible strategy, right? And what's crazy too is like when I talk to people, especially young people, about financial literacy, I'm like, look, all the skills you need mathematically, you learned in like second grade, right? I mean, it's not that hard. You don't have to be a calculus major. Yeah.
Yeah. And, and it's interesting. Like if you take a look at some of the highest trending topics on social media, um, it's like stupid pet tricks, followed probably by health and fitness. People want to look better about, they want to feel better about themselves. They want to lose weight. They want to diet. I mean, like on my feed, and this is partly because I'm interested in this stuff. But on my feed, like every other video is, high protein intake, diet tips, those type of things. And I'm in the finance business, but there's very little good quality financial content that actually comes.
Well, I think quality was the key word there. So I'm not on TikTok, but the TikTok videos I see around money, and I believe there are a lot of them, but they're all like get rich gimmicks, get rich quick gimmicks, right? It's like, oh, fold your money this way and it'll multiply. Or the dude who was talking about taking out the business loans to buy Rolexes and flip them, or what? I mean, it's scam
Terrible.
stuff.
Yeah, terrible stuff.
Terrible
But yeah,
stuff.
it's just interesting. I mean, we pay more attention to food and exercise, which is important. Don't get me wrong. I mean, you and I talk about health and fitness and how that's very important to, your future outcomes. Wealth is great, but if you don't have any health, it's what's the money good for, right?
Right.
If you can't do anything with it. But again, we just pay so much attention to our health, but we pay such little attention to our wealth. And I just think it just fascinates me.
I'm going to push back on that too, because I don't think a lot of people on average pay attention to their health. I think they're watching those TikTok videos because they've got beautiful people with abs in them, right? And there's a hope and aspiration that maybe one day I'll do that. But I think they're watching that and then they're door dashing Domino's.
Yeah, but yeah, you know what? I'm not going to argue the point. So I think
Yeah, yeah. All right. So one other story I want to tell, and I did get this gentleman's permission to share it. So the night before the conference, uh, you guys did sort of a VIP cocktail type party, and I ended up kind of closing it down. And I was talking to a couple there. By the way, I also should say too, real quick. Um, I was also really encouraged by the number of younger guys who were there, and I'm talking guys in their late teens, early 20s. They came with their parents, and I asked a couple of them on the side, like, "All right, are you getting dragged to this thing?" And they were, no, no, they were like really interested in this. I'm following this. I'm planning to be an economics major or whatever. So it really did give me heart that there are members of the younger generation for us older guys to pass the torch to in terms of financial literacy. But anyways, so I was talking to a lot of people during the night, and the place is closing down. And there was a guy standing right next to me, and I was like, "Look, I'm gonna have to get out of here." And as I was walking out, he said, "Hey, look, I just want to walk you out. I'm not gonna slow you down. So I just want to tell you how much listening to you and Lance has really changed my life." And he said, let me just quickly break it down for you why. And he talked about how his mother had gotten very old and ill, and he was having to manage her money for her. And his father had managed the money in a very particular way that was probably really overly conservative, like CDs and type of things like that. And the CDs she was in weren't really yielding anything, but he didn't feel like he could change the approach while she was alive because it would stress her out, right?
yeah,
She was like, "Look, this has always worked. You're deviating." He didn't want to just give her that stress in her last years. So she passed away. He inherited his half of the money, and basically said, "Look, at that point of his life, he wasn't sure if he was going to be able to retire." He worked a state job, and he said, "Look, this is my last chance. I don't have time in my life to go through another cycle if I don't manage this money well." And he ended up reaching out to RIA. He ended up working with John Penn
Yeah.
at your place there, Lance,
Awesome guy.
and said that the basically the performance since he's done that, and look, performance no guarantees, it differs for everybody. But he said now retirement is not even just a possibility for me, it's becoming a probability. And I cannot tell you like the psychic weight that has lifted from me and how that is changing my life. And so, yeah, I just thanked him for sticking around and sharing that story with me and telling him, yeah, look, that is the absolute best feedback that guys like you and I
Yeah.
can receive, because that's exactly why we're doing what we're doing, right? I mean, we're trying to change lives for the better. I don't pretend that we're successful in that all the time, but when we do really give somebody a pathway to a better future, man, does that feel good.
No, and look, you and I spend a lot of time talking about the price of silver, the stock market, and all those type of things. And I've said this on my radio show before, in my YouTube channel, which is, what I do inside of our company is the least important thing. And, that's just the management of the assets. That's all I do. I just try to make sure the money grows over time. That's my job. But that's the least important part of building your retirement and getting to that goal. And again, John Penn I've worked with hundreds of financial advisors over the course of my career. And, I can't tell you how blessed I am with the group of people, Richard Rosso, Danny Ratliff, John Penn, Jonathan McCarty. These guys are rock stars in terms of the financial plan. I've never worked with guys as smart and dedicated as these guys are. And when it comes to financial planning, you can't ask for anybody better. But that's that financial plan, which everybody, it's kind of like, it's what I was talking about a minute ago about we don't pay attention to finances. The fact that people don't have a financial plan is beyond me, because that's the blueprint for building wealth. Once you have that
Exactly.
financial plan in place, then you know how to invest. And it just fascinates me that people invest money with no plan. And it's like building a house without blueprints. You'll get a house, but no telling what it's going to look like. But you don't realize how much when you do that way, when you don't have that financial plan in place that dictates how much risk you need to take, tells you, what your savings rates need to be, those type of things to reach your goal. You wind up taking on a tremendous amount of risk in your profile, because all you have to benchmark against is just chasing the market,
Right.
rather than looking at your financial plan and saying, look, I need 6% a year. That's what I need to hit. That's my number. If you don't have that, you just start chasing markets. You take on this exceptional risk, and then you have the corrections that eventually will come that winds up setting you back years or even a decade from your goal, because you didn't have that plan to work off of. And that's one of the most fascinating things that I find about individuals when I talk to them is like, oh yeah, I'm a DIY investor. I'm like, that's fantastic. Me too. I'm a DIY investor. And I said, how do you, how are you investing in what are, kind of what your goal structure is like? Oh, I just look to beat the market every year. I'm like, that's a terrible plan. They're like, why? It's like, well, what happens when the market's down 50%? If you're trying to chase the market on the upside, you're going to beat the market on the downside too. And they're like, I never really thought about it that way. I'm like, yeah, that's, this is why you and I spend so much time talking about risk management, taking profits. I don't care what assets you're invested in. You can make money in it. It doesn't matter. But, understanding the risk profiles that you're taking, understand how to manage that risk is what's important. Because again, price volatility is not risk. And this is a big mistake that investors make. They go, oh, well, I look at volatility as a measure of risk. Volatility is not risk. Risk is the potential of destroying your wealth. And if you lose your wealth, you're out of the game. You're done, right? It's like going to Vegas, betting all on black, and it turns up red. You're done. You go home, right? That's risk. And that's what you need to be mitigating against in your portfolios.
Well, and so as we've talked about, understanding risk personally is really the most important thing that you need to do here, because you may find I don't need to get 8% or 9% a year to hit my goals. I only need 4, right? And so you can get to where you need to go by the time you need to get there with an awful lot less risk, right? So all of a sudden, the chances of you being knocked out for a decade or more, they drop precipitously, right? You can sleep much better at night, right? The key thing is having the plan, but then also, as you've said in the past, Lance, is revisiting that plan and updating it. I mean, how many people do you know? Yeah, I have a financial plan. Okay, great. When do you put it? When did you put it together? Oh, about 8 years ago. Right? Well, when's the last time you updated it?
Never.
8 years ago.
When was the last time you looked at it? Eight
Yeah.
years ago.
Yeah, and it's so funny because like, with the advisor I probably have the majority of my assets with, they use a financial software for financial planning. And I was calling them so often to run scenarios on it. They just said, Adam, let's just train you on the software. Here's the software.
Yeah.
Use it yourself whenever you want, right? And so I just geek out, every couple of weeks to get on, I play around with stuff, right? So,
No, we do that as well. So, we update our financial plans for our clients every single year. We have reviews with them, those type of things. But they have access, all of our clients have access to their financial plan and they can go online and we have, listen, it's funny because I hear from clients like they're up at 2 o'clock in the morning. It's like, oh, I was laying in bed and I had this dream about this. And so they'll get up and log in and start messing with their financial
mhm.
plan, for whatever reason. And, I think it's fantastic, right? When you're that
That's me,
engaged.
by the way. I'm that type of client. Yeah.
Yeah, yeah. But when you're that engaged with your money, your success rate goes up dramatically
Yeah.
because you start understanding things. You make a really good point a second ago. I just wanted to encapsulate that for
Yep.
listeners, which is you said, look, if you're, I'm going to use an easy number. We'll use 4%. So let's say your financial plan says you just need 4%. Who wants 4%, right? That's boring. Market's up 20%. So what if I got five? Okay, and again, we're going to keep this just math wise.
Yep.
So to go from 4 to 5, that's a 25% increase in the rate of return, right? So I just want an additional 1% gain each year. That's a 25% increase over your 4% goal.
Yep.
The problem with that is the amount of risk you have to take for that 1% additional gain goes up by almost double. It's an exponential increase in risk for every percentage point rate of return over your goal that you need to make. And this is why not having a financial plan is so detrimental to your future outcomes because you're kind of just throwing darts in the dark, hoping to hit the dartboard. But a financial plan will help you navigate that risk profile that you will drag yourself into unconsciously by not having a plan to work off of. Anyway, I think we won't
Okay.
beat that horse to death, but there you go.
Yeah. Okay. So, folks, we're going to get back to the discussions of the markets. And Lance, we're going to get to your South Park post in just a second here. But the reason why we're spending so much time on this right now, folks, is because of what Lance said at the very beginning, which is this is a market where correlations have largely gone to one, and the rising tide is rising, just about all boats right now. And this is where people just don't want to hear about risk mitigation. It's boring. It's not sexy. It's not fun, right? But this is where it matters the most. The moment that people start taking losses, they're going to care. This is all they're going to want to hear about. How do I mitigate risk? How do I get back to where I was, right? But the problem is that the information has much less value then, right? So we're just trying to hammer it home right now while times are good and the sun is shining. This is when you want to thatch the roof. This is when you want to think about defense. All right. So Lance, last year, at the beginning of last year, you wrote a seminal post called Curb Your Enthusiasm. And it was all about, setting expectations for the year. I would say, you might feel differently. I would give that post maybe a B for
Hmm.
how the year turned out.
Yep.
Because definitely it started out really volatile and the piece was really timely there. Then we kind of went back to the old
The
look,
old playbook.
market's just grinding higher and
Yep.
the Teflon market, nothing,
Yep.
nothing sticks to it. This piece is sort of a revisitation of Curb Your Enthusiasm. You're now picking a different TV show, South Park. Um, Let me just hand you the baton. You can tell people why you wrote it, but I do believe it's in the spirit of what we've been talking about here.
Yeah, yeah, no, and again, so in terms of curb your enthusiasm, the point of that article is that all Wall Street analysts were extremely bullish, and nobody was looking for any type of volatility. And the point of that article was be prepared for volatility. We think
Yep.
we thought the market would end up about 10% for the year. We did 17. So yes, get a B rating on the article for missing returns by 7%. But we did have volatility. I had a 20% decline kind of mid-year. Now everybody forgets about that because the markets did so well, but everybody forgets about the volatility that happened in between. So, and I think that is a good kind of backdrop when thinking about 2026. So we'll just share some charts with you from the article. Right now, Wall Street forecasts for 2026 are all expecting near 15 to 16, 14, 15, 16% gains on average. So, I mean, they're very optimistic about this coming year for a whole, and again, this whole premise is based on economic reflation, which is a surge in economic growth with no inflation. So
Mhm.
that's kind of the premise for this year. The Fed's going to keep cutting rates. And over the next couple of weeks, we're going to revisit, you and I are going to revisit this article, not this article, but I've got a couple of articles coming out over the next couple of weeks talking about this reflationary cycle and the risk that we need to be paying attention to relative to that reflationary idea,
Yeah.
and what
And
we
just
think
to
can
note,
happen.
this reflation without inflation is what the
Yeah.
administration is selling hard right now.
Yes, absolutely. Everything's going to be fantastic. You're going to have economic growth, higher wages, all going to be great, but no inflation. So, um, we'll see how that works out. But, and again, that's why I'm writing some articles on this. So we're going to rehash this topic a couple of times here over the next couple of weeks
Yeah.
because I think it's really important for positioning portfolios for the rest of this year. So again, everybody's very
Hey,
bullish.
Lance, do me a favor. Just magnify the chart if you can, if you're going to bounce through a few more.
We're going to clip through a few more here.
Yeah. Just
So
thinking of the
again,
boomers like me, the guys like me whose eyes are going.
no problem. So let's talk about market structure. As kind of the first, this article kind of goes through three phases: market structure, and then kind of the underlying fundamentals. But one thing we've had over the last 3 years are these exceptionally large outsized returns, which now put us about 18% above the 3-year moving average, and that's an inflation adjusted real return basis. So we're the markets have had exceptionally high rates of return, and that's very hard. That structural nature of the market is very hard to maintain. In other words, the odds of having 4 years, not saying that it can't happen, but the odds of having 4 years of above average returns is going to be much harder to accomplish simply because of the natures of the markets. And again, this goes back to the reversion to the mean. And again, it's not just the stock market, it's silver, it's gold, it's precious metals, it's any asset, it's mid cap, small cap. You kind of look through markets, a lot of these markets had exceptionally high outsized rates of return over the last few years. And that reversion to the mean becomes a function of process over time. It's a structural foundation of the market. That gravitational pull will create that reversion. Now, does that mean that you're going to have a 50% decline in the market? No. What it does mean, though, is that returns could be substantially lower over the next couple of years. Maybe we're doing 5, 6% rates of return in assets versus 18, 20, 30, 40, whatever they are. You're going to have that reversion in process. So structurally, something very much to pay attention to. This is the deviation of valuations for the stock market. Again, this is using the Shiller Cape ratio, but this is the deviation of valuations from the long-term exponential growth trend of valuations going back to 1900. We're currently at about 167% deviation from that long-term exponential growth trend, and we've only seen that peak back in really around 1900 was the last time we were even close to that peak, and we went through a 20-year secular bear market during that period before we had the run up from 1920 to 1929. So again, this is not something that you go, oh, market's going to crash tomorrow. That's not what that means at all. These valuation levels, and you can see here, even back in the early 1900s, you kind of peaked at those high levels over about a 10-year period before the markets actually started going through a big mean reverting process. So these things can last much longer than you think, and this is why it's important not to immediately react to valuations, because valuations in the short term over the course of a year are simply just a reflection of sentiment. So everybody's very bullish about the markets, everybody's very optimistic about the markets. That's all fantastic. But, you know, valuations longer term do tell us that the risk of reversion are becoming much larger.
Hey, can I just say one thing here?
Yeah.
So, uh, it, right now, there are charts out there. You've shown a number in the past that show
Mhm.
that forward returns, 5 year, 10 years, are projected to be negative for the markets given today's valuation levels, right?
Right.
Um,
Like this one?
like that one, exactly like that one, right?
Okay.
So go back to the other chart for a second, the one you were on before. Um, so, a lot of people who are watching here, Lance, are older, right?
Right.
Um, we don't know what's going to happen in the next 10 years, but let's just assume that that prediction is true. And let's even just assume that it just goes sideways, right? The market
Mhm.
just goes flat for 10 years.
Sure.
Um, you know, there's a lot of people who don't have the ability to recover from a lost decade, right?
Right.
And you're showing here that, like the 1900 one, that was a 20-year bear market. And a 20-year bear market is actually more the norm than not, looking at this chart here, right?
Well,
And so,
yeah. So, just real quick to your point,
yeah,
1900 to 1920 was a secular bear market. Then you had a secular bull market from 1920 to 1929. Then you went from 1933 to 1953 before that bear market ended. So there was another 20 years. Then you went from 1962 to 1982 in the next bear market. These bear markets last just about as long as the bull markets last. So again, if you take a look at 2008, that was the bottom of the secular bear market from 2000 to 2008. It then took 13 years basically to get back to even in terms of returns. So you say, okay, well, from 2013, if I have 15 years to 20 years, in a secular bull market, we're getting closer to the tail end of that rather than the beginning, right? So, to your point, don't dismiss these periods of low returns. That doesn't mean returns are low every year. You're going to have some really good years, but you're going to have some down years, right? So think about 2000 to 2013. That return was zero on an inflation adjusted basis, but you had two 50% corrections in that process, right? And
right.
that's what really damaged a lot of people that were trying to retire in 1999, 2000, they didn't retire.
Yeah. And that's where I'm going with this, which is, look, folks, is this the peak? We don't know. Could the bull market last for another 10 years? Yeah, sure, probably. I mean, possibly.
Yeah.
Um, the point is, if you're 65 and we're just about to enter a 20-year bear market, you know, that's that's really unpleasant. Like, a lot of your retirement dreams are
Mhm.
going to get wrecked by that, unless you're positioning yourself in such a way to try to not be as vulnerable to the downside of that cycle, right? And I'm just guessing, Lance, like, in at 1900, the folks who somehow managed to avoid the worst of the downdraft, just on a relative basis, were way better off than the vast majority of the rest of Americans here. And so,
Yeah.
yes, in this type of period, an active investing approach is probably going to work much better than a passive investing approach. And you may actually be able to make some good money during a
Yeah.
period like this, if you catch the good years.
Yeah.
And look, I'm not trying to sell fear. I'm not trying to tell everybody, hey, you gotta sell everything because it's the top right now. I'm just saying, probabilistically, this chart is saying at some point in the not too distant future, it's probably more likely than not, we're going to enter a prolonged bear market at some point. And if
Mhm.
you're approaching retirement there, you want to make sure that you are taking steps at a minimum to try to, position your portfolio to not take 100% of the downside.
Right. And look, and this is why it's important to monitor we're talking about the market here, but if markets begin to move into a bear market, it's going to be every asset class that went up at the same time is going to go down at the same time. So because money's going to rotate within markets. So whatever asset you're in is like, oh, I'm not in stocks right now. I'm in silver and gold. Fantastic, great. You're having an awesome run in that. But when money starts to leave the market, it's going to leave the market across the board and it's going to look for the most undervalued, risk averse asset, which right now would be treasury bonds because they've been unloved now for about 4 years. So, those you're going to start to see that rotation of money. If it occurred tomorrow, that's what you would see happen. Now, the next bear market, secular bear market period may not start till 2030, right? So, we may have 5 more years of this type of a market and life is good. Everybody's happy. We've got data centers, we've got all this other stuff going on. But what we do know historically, going back to 1900, that these markets cycle about every 15 to 20 years. And the upsides are fantastic and the downsides are brutal. And you're just going to have to be able to navigate through that. And again, I was talking about real quick, Adam, this is the point about valuations. And again, a lot of people are saying, "Oh, valuation," and this is why I want you to be really careful when you take a look at valuations and talk about them, is because everybody looks at valuations goes, "I got valuations are high." Everybody's been saying the market's going to crash for 3 years now, and it hasn't crashed. So obviously, valuations are wrong. Um, the problem is in the short term, and this is consumer confidence, and this is consumer confidence of higher stock prices in the next 12 months overlaid against the rolling 12-month PE ratio. And you'll notice there's a very high correlation. So, in other words, all valuations tell you in a 12-month period is what consumers think about stock prices. That's it.
Yeah.
We're willing to overpay for valuations right now because we think asset prices are just going to go up. There's no risk in the market. It's fantastic. Now, this was the chart you were talking about. This is forward 5 year real returns based on Cape valuations. So at current Cape valuations, the forward 5 year return from today is somewhere around zero. That's what history tells us historically going back to 1900. Now, does that mean it has to happen? No, but whenever you've had these levels of valuation, 4 and 5 year returns have been they I tell you what they ain't 20% a year.
Yep.
So, I think that we've milked a lot out of, kind of where we are. But again, I think you have to be more cognizant about what you're paying for asset prices right now.
Yeah, and just to add to that, and Lance, while I'm talking, if you can expand the size again a little bit, I think maybe it's
Sure.
shrunk back a bit. Um, but let's say you're somebody who's listening closer to the administration. You say, you know what, Lance, I actually think the economy is going to do great this year. I'm
Mhm.
picking the over on the GDP. I think
Yeah.
maybe we could get 5% GDP growth.
Yes.
While stock prices are a function of earnings expectations, so earnings go up, in general, that should be supportive of stock prices. This goes back to valuations, right? It's price versus value. And right now, prices are extremely deviated in terms of a multiple, in terms of average multiples that we've had in the market. And my point here is you could be right, and we could actually have an economy that grows faster next year. That doesn't guarantee the stock market's going to continue to go up. In fact, you could have a stock market correction or pullback even with a growing economy.
Absolutely. And you brought up and you started that whole statement with exactly the right issue, which is earnings expectations. This is the deviation of earnings. And over here on the right-hand side, this is going through 2026 earnings expectations. The expectations for earnings growth this year puts earnings growth at the highest deviation from the long-term earnings growth trend going back to 1900 ever on record. We're at 44.4% deviation right now. Tech bubble was 35.87. The real estate bubble is 42.45. So, even in we had the liquidity bubble going into 2015, we weren't there. And even in going into the pandemic, we weren't anywhere near these close to that. So, you've got very high expectations for earnings in an economy that is looking at slower employment growth. I was just posted a chart this morning talking about real disposable incomes are declining, savings rates are falling. That's so falling savings rates, are good for economics in the short term because that means people are spending money. But if you take a look at GDP growth over the last 2 quarters, it's been almost entirely a function of tariff issues, which is net imports and exports. So when you take a look at net exports as a percentage of GDP growth, it's normally doesn't show up. It's a very, very small fraction of GDP growth. It's been very big parts of the last 2 quarters. Now that's going to eventually reverse. Most of that's been gold exports to get ahead of tariffs, and worrying about future tariffs. This recent tariff threat over Greenland was another good example. Those gold exports have very little to do with the economy, but it has a huge impact on what's happening with the GDP calculation. So you're getting this, exceptionally strong growth in something that actually has nothing to do with actual economic growth. And
Mhm.
and I think the payback on that is going to come this year. And we may see slower economic, I think we may fall short of these economic growth expectations people are hoping for.
Right. And I think that came up in the live weekly market recap that we did on stage. if memory serves correctly, you were taking the under
Yeah.
for the year. Yeah.
And
Right
again,
now,
I
yeah,
I can,
your eyes are open to that potentially changing, but right now you're starting with an under.
well, and look, I think the way to couch this is I think we just need to go into this year with kind of wide eye, eyes wide open to a degree. Is like, look, the bullish case is great. The bullish case is awesome. That's the easy part of the strategy, right? I'm invested. We're over allocated to equity risk right now. Portfolios are doing great. I don't have to do anything with the bullish case. If the bullish case comes to fruition, I'm fine, right? It's kind of like I'm driving a robot Tesla at the moment. My hands aren't even on the wheel. We're just cruising down the freeway. Everything's fine. So the only thing I have to worry about is if something goes wrong. And so that's why I'm spending a lot more time here over the next 3 weeks focusing on the potential risk
Hmm.
that could occur because if the risks don't occur, I'm fine. The markets will do great, my portfolios will do fine, my clients are happy, awesome. But what I've got to be prepared for is the thing that goes wrong so that my clients don't have heavy impacts because of that.
Yeah, and folks, this is, in my opinion, what you want in a good financial advisor is you want somebody who is, kind of neurotic when times are going really well, for exactly the reasons that Lance mentioned. And similarly, you want somebody when everything looks awful, somebody who's trying to look for the light at the end of the tunnel as well. Hey,
Exactly.
real quick, just because you
Sure.
mentioned it, did you see the headline yesterday that a couple of guys basically did their version of the cannonball run in a Tesla with full self-driving? They had the car drive them from LA to New York, and they didn't touch the wheel the whole time.
Really? No, I did not see that. That's awesome though.
Yeah. Yeah. So yeah, it just shows that look, this technology age that we are hurtling into is continuing to improve at an exponential rate.
Yeah.
All
Also
right.
saw a headline yesterday that Elon Musk was taking safety managers off of the self-driving cars in Austin. So I'm not sure what that means, but
Well, actually, I saw an article today, and this is just a headline, so it could be wrong. They're now in follow cars, so they're
yeah.
not in the car itself,
Okay.
but they're in cars behind just to make sure that nothing goes wrong.
Gotcha. Gotcha.
Yeah,
Gotcha. So yeah, I'm still look. I At the end of the day, I'm still kind of a control freak. So I'm
yeah,
personally not quite ready for robocars. I'm sure a lot of you are. Hey, YOLO, you only live once, right?
right, right. What's interesting though is apparently auto insurance companies are now
Mhm.
offering discounts for Tesla owners who use the full self-driving because statistically the cars get into accidents less.
Well, yeah, but you
So
don't have a lot of history on that. That's the
you
only
don't you
problem.
don't have a lot of history, but it
Yeah,
is interesting, which is
it is
if
interesting.
if they indeed prove it. And look, uh, I mean, I'm like you, Lance. I'm kind of a
Mhm.
dinosaur and probably will never feel fully comfortable with my hands off the wheel. But I also know that, you ask humans if they're, people, if, are you an above average driver? And about 87% of people say yes, right? Which mathematically isn't possible.
Right.
So I'm going to bet that the collective, wisdom of the technology does drive more
Hey,
safely than the average
you
American.
know what? And here's the bottom line of all that. I am all on board with everybody having a robotic car if it gets rid of traffic in major cities.
Yeah.
You know,
Well,
I am all for it. We may go 30 miles an hour everywhere, but at
yeah.
least, these when people have accidents on major free, especially here in Houston, right? It just backs up traffic for an hour. So I'm all for
Yeah.
it. I'm all for it.
And not to turn this into an Elon love fest, but I mean, I mean, the research totally shows too, like merge lanes and things like that. These are
Mhm.
where the big bottlenecks occur, and they occur because people aren't moving efficiently, right? It's you just trust the car next to you, so you slow down too much and whatnot, right? Where if it's all being kind of controlled by, the hive mind of the AI, everything can move as efficiently as possible. So you probably won't get the 30-mile an hour crawl. But you also add things like the Boring Company into this, right? Where, we can
Yep.
have these kind of underground express routes and stuff like that. Like who knows? Traffic might become an artifact of the past in 10 years.
Hey, I'm 100% all for that. All right, back to the topic.
Back to the
Uh,
topic.
this is the World Economic Outlook from the IMF for 2020. This is as of October 25 for 2026. And the interesting thing is that Europe and emerging markets, they've been on fire lately. They've been doing great. Small caps and mid caps have been on fire. They're underperforming pretty dramatically here on Friday, but they've been doing very well. on this idea of this economic resurgence, yet the IMF is projecting 1.1% economic growth in Europe and 2.1% growth in the US. That's well below what Wall Street's currently expecting. So,
Yeah.
so again, I'm not saying that's the case, but just fundamentally, we're now moving into the kind of the more fundamental structure of the market out of the structural side of it. I think that's something worth paying attention to because economic growth is where revenue and earnings come from. Without economic growth, you can't have revenue and earnings. And that's going to be the big watch for this year.
Yeah, I don't think I'm going to be able to. Well, I don't think the probability is super high, but folks, I am going to do my best to try to get somebody close somewhere to the administration. Um, my dream would be Scott Bessent, and actually, without outing them, one of the people I interview is actually friendly with Scott Bessent and has said, "Hey, Adam, I'll pass your request along to them."
Okay,
But I want to
awesome.
get somebody from the administration who's close to the economic side of things to come on here and just make the case for the 5 to 6+% GDP growth this year.
Yeah.
Not saying I'm going to be able to do that, folks, but just letting you know I'm trying my best. And if anybody watching has a connection there, please just email me at adam@thoughtfulmoney.com and I'll respond right away.
Yeah, absolutely. So kind of moving into more of the kind of the fundamental, kind of backdrop of this. Household equity ownership of the S&P 500 is at all-time records. So you've got, it's interesting. We talk about this, right? We say, well, only 20% of the market is, 90% of the market's owned by 20% of income earners, but yet household equity ownership's at record highs. And this has a lot to do with passive investing as well as, 401k plans, which are,
Yeah,
which by the way, as we've talked about before, 401k plans are a very small factor in the overall market. Only 25% of employees actually use their 401k plans.
right.
So it's sad. All right. More people should be contributing to a 401k plan, but it's not as big of a factor as a lot of people make it out to be. But passive investing by individuals at the household level has risen. In fact, one of the bigger concerns right now, I think for 2026 is that in 2025, you had 1,000 new ETFs come to market. So every year we've just had an explosion in new ETFs come to market, but last year it just went surging off to the moon. And a big majority of those were leveraged and single stock leveraged ETFs. Um, the issue with that is that this is kind of reminiscent of what we saw in 2021 when we had this big rush to get SPACs to market. We couldn't get companies to IPO fast enough, so we started doing SPACs and all kinds of other stuff to meet that speculative demand in the markets. And you're seeing that again with these ETFs. ETF providers are happy to provide you an ETF. If there's even an incremental piece of demand for something, they'll throw an ETF out there for you. And the problem with ETFs though is that you need about $10 million in AUM, assets under management, just to make it viable to launch an ETF. You need about 50 just to break even on it. And to make some money with it, you really need about 100 million under management. So the point about that is that a lot of these ETFs, especially the leveraged ones, are going to wind up going away because of the leverage. And again, we saw a lot of 2x leveraged ETFs come out. We talked about recently there was this push to do a 5x leveraged ETF.
Right.
A
Thank goodness
lot,
they put
thank
that one
God
on
those,
pause.
yeah, thank God those didn't go through. But just as an example, let's say you've got a 2x leveraged ETF on some asset, and it's got a limited amount of assets under. This is why I always want to take a look at the both the volume of the ETF, how often it trades, and also look at the underlying assets under management. But let's say you've got a leveraged ETF, which is using options to create that value. And if that stock price goes nowhere for a period of time, in other words, whatever it's tracking goes nowhere for a period of time, the optionality inside of that ETF will continue to erode the value of your ETF. And eventually you could wake up one morning and they close the ETF because they're simply not profitable and they'll close that ETF on you. And you may or may not get money back depending on where it closes. There was recently a ETF. It was that was issued, and the notice was sent out. It was a 2x leveraged ETF, and a notice was sent out to owners of the ETF that the value of their ETF as of that day was 0.0000.
Oh, geez.
So, it can happen. And so just be careful. But the bigger point here is that households are all in. Everybody's in the pool in terms of either equities or precious metals or whatever it is. They're all invested. They're 100% in the markets. And because of that, Wall Street is rushing to get more product because it's an asset. It's a land grab for assets, right? If I can
Right.
just get something out there, I can get some assets and make some money. So there's this big rush to get out there, which means you're getting poor quality product coming to market. Your risk is going up exponentially. And when this reverses, that kind of adds the fuel to the fire because of forced liquidations that will occur as a lot of these things have to unwind, delever, and basically close up shop. So this is one of those structural underpinnings that is not, this does not mean markets are going to crash tomorrow, but this is that fuel to the fire, right? That's the kindling and that's the lighter fluid, kind of on the coals. All you're missing here is a catalyst for that reversal. And same thing here. This is margin debt. So there's been a lot of analysis about margin debt. This is margin debt as a percentage of real disposable income. And the reason I
Hmm.
did this one is there was an article by Bloomberg. I think it was Simon White did an article in Bloomberg looking at margin debt as a percentage of GDP. And I was looking at that saying, well, that doesn't quite measure what's going on within the markets because
Right.
economic growth comprises a lot of things, right? You have imports, exports, you have government spending, you've
Right.
got household personal consumption. So
And
maybe
it can be
there's some value
distorted
there.
by like what's happening with gold with the
Yeah,
tariffs and stuff.
yeah,
Yeah.
yeah. And you get some bifurcation there. So, but if you take a look at margin debt versus real disposable income, so this is what individuals theoretically have left after they pay taxes on
Right.
their money.
This is not dissimilar to a home price to local incomes chart, right?
Exactly.
Yeah.
And so what this is suggesting is that individuals have run out of capital to invest and they're now, so my real disposable income, I can invest out of that. I've now used all of that to invest any of my savings I've now invested, and now I'm turning into margin debt. And that's the highest level that we've seen ever on
Yeah.
record. Now,
I
does
think this
that
is one of the scariest charts you ever showed me.
again, this is bullish, right? Margin debt going up is bullish because it provides buying power for the market. What's
It's
important
bullish
is
while it's going up. Yes.
correct. It's also fuel for the fire when it goes down because that's the liquidation event on the other side. So again, just one of those structural issues. Nothing doesn't mean anything today, but I think this adds more of that fuel to the fire, so to speak, that if there's a catalyst that ever shows up that ignites the sell-off, there's plenty of fuel behind it to make it a bigger sell-off than a lot of people are expecting.
Okay. Hey, can I make one corrective comment here real
Sure,
fast?
of
Can
course.
you go back to the pull up the chart you had two charts ago? Thanks, Lance. So yeah, here I just in case folks got confused earlier. So these two things can be true at once, which is we can have record high household equity ownership, and we can have 90% of financial assets owned by the top 10%, and that's
Yes.
the stat that's been out there.
Yes.
And the way to understand this is yes, more and more households may be participating in their 401k or whatever. They just might not have that much in it compared to the top 10% of households, which have basically all the wealth. And they own 90% of the stocks
Right.
that are out there to own, and the rest are distributed amongst the other households there.
Correct. And again, if you look at the bottom 50%, they own like 2% of the market.
Yeah,
Right.
exactly. I
They
mean,
barely show up.
basically, the only tie they have to how the stock market is doing is if your company's stock gets hammered and it has to lay you off, then it matters, right?
Correct.
But otherwise, their lives aren't that impacted by what happens in the stock market.
Exactly right.
Yeah. Okay. I guess they're impacted in the sense that those who do own assets are just getting further and further ahead of them, which is,
Right.
something we have ranted about a lot.
Well,
Um,
that's the K-shaped economy that we were talking about earlier.
Right. Okay, so a couple other topics I still want to bang through in the time we have left, but real quick, since we're still kind of on the markets, Lance, do you mind just doing a quick TA and
Sure.
showing where we are right now? Um,
Yeah,
and
absolutely.
what's interesting is we are closing in on 7,000 S&P, as I mentioned earlier. And Lance, it looks like we're going to hit 5,000 gold before we're going to hit
Mhm.
7,000 S&P.
Right.
Gold, at the time we're trading here, has less than $15 to go. Silver is now at 101, just FYI. S&P is down on the day. It's got almost 700 bucks it needs to go to get to S&P is
So we're up.
50 bucks. It needs
Yeah.
50 bucks to go.
Yeah,
Um,
we're still up so far on Friday right now, but
yeah,
yeah.
marginally, right?
Yeah.
Yeah. Okay. But despite the fact that we're knocking on the door of 7,000 S&P, if you go back here, and maybe I need to have my glasses on here, but the S&P hasn't really gone that far since what,
Mm-mm.
October? You've
Right.
got this sort of rising wedge there from the low that we saw in mid-November. But if you go back further, the October high isn't that far away from where we are right now.
No, no, it's not. And Tuesday, so Monday was a holiday, right? So nothing happened on Monday, but on Monday, we were starting to worry about this whole, issue about Greenland. Then on Tuesday, the markets opened over this whole Greenland concern. There was some comments by the White House, maybe about using force or whatever it was. And again, as you and I have talked about before, the White House is very good about using the stick and carrot, and why the market keeps buying off on these announcements of, we're gonna impose tariffs on Europe across the board, over this Greenland deal. Why anybody takes that seriously is beyond me at this point.
It's like Charlie Brown with the football. Like, when is he going to learn that Lucy's going to pull it, right?
Exactly. And yeah, so why yeah, so yeah, Adam, you're absolutely right. Why the markets, respond, like they do relative to these, announcements beyond me. But what it does show you, one thing that we've talked about here before, is that when markets are rising, the reason markets go up, there's only one reason that prices rise, is because sellers are being dragged into the markets. So a good example today, you were talking about silver earlier. So silver's up sharply today, and that's because the sellers of people willing to sell silver today are saying, yeah, I'll sell it to you, but you're gonna have to pay me $100 for it. And then somebody does that. And so the next seller goes, okay, you're gonna have to pay me 101 for it. And then somebody does that. And so the seller sells. But the problem with that is that the buyers are now way below that number. Somebody willing to buy silver or in bulk are sitting much lower than that $100 a share. So in other words, as prices rise, you have a marginally fewer number of buyers and sellers willing to transact that price at that level. The bulk of buyers are sitting much lower. And that's what you saw on Tuesday with the markets. Is buyers were there. They were 2% lower in the markets.
hmm
And we saw retail investors in particular, heavy buyers of S&P 500 indexes on Tuesday. And that's why this week, the Mag 7 stocks have been doing very well. Google, Microsoft, Amazon, Meta, they've been up sharply this week because all that money flowing into passive indexes is fuel. 40 cents of every dollar, as we talked about before, fuels those stocks. So you're seeing those stocks go up because of that buying of those indexes. So importantly, technically, we had a little bit of destruction here. We had this rising wedge pattern, which was great. We broke that bullish trend line on Tuesday. That trend line is now resistance to this rally. So if we get a rally back up here close to the previous highs, we're going to intersect to the bottom of that rising trend line. So that may make it a little bit difficult here temporarily for stocks to get make new all-time highs. We're also on a momentum sell signal right now, which suggests that markets may be a little bit weak going into next week. Also, money flows have turned negative here temporarily because of that sell-off on Tuesday. So we need to see that recover as well. But next week and the week after, we have earnings. We're going to get into the heart of earnings season next week. And then the following week, we get Apple, Microsoft, Tesla, and Meta. So you're going to get a lot of the big boys coming up, not this coming week, but the week after. So over the next couple of weeks, we're going to have about 80% of earnings hit the markets. That opens up the buyback window for this market. And again, so part of this sloppiness that we've seen here as of late is simply a function that you've had no buybacks going on in the market because that window's been closed.
And I was just about to ask you about that. So, how concerned are you about the market's prospects in the next couple of weeks as capital flows seem to be turning negative? The buybacks window is shut or ending, and we're not going to have that marginal buyer back in the market for what, 3, 4 weeks from now?
Well, it's a great question. It all hinges on earnings next week.
On how good they are.
Yeah, well, so Netflix was a really good example. Netflix reported really good earnings. Their revenue growth was good. Their earnings numbers were good. They hit 375 million subscribers. I mean, Netflix is killing it. They're doing really well. But the stock got hit by almost 7% after their earnings because of their forward outlook. So again,
hmm
it's not going to be what these companies report. it's going to be about what they say about the rest of this year. And if their guidance, so two things are potentially, and so here's two of the potential risks. We talked about those earnings being very optimistic for this year. If we go through this quarter's earnings season and outlooks are starting to get cut back, we're going to see those earnings estimates drop. And that's going to make valuations more difficult to justify at current levels. So that may induce some more risk into the markets worth paying attention to. If outlooks are fantastic, awesome, right? Markets are going to do great, and particularly around the AI story, right? So Apple, Microsoft, Amazon, Google, NVIDIA doesn't report till the end of February, so we're going to have to wait for the king of AI to report for another month and about a month and a half ish. So, we've got a lot of stuff coming up that's going to detail that narrative around the AI story, the CapEx spend, the data center build outs, the infrastructure development. That's the things to really be paying attention to here for over the next couple of weeks, because a lot of it will define both the economic growth expectations and earnings expectations for the rest of this year.
Okay. Let me ask you this, Lance. So one of the things you and Michael have been talking about, we talked about this at your conference, is capital rotation.
Yep.
And this year, the big hyperscalers have been weaker than they've been, and we've seen capital flow into mid caps, small caps, other industries.
Right.
And of course, one of the big questions that we've been talking about is okay, is this just a little blip, or is this going to be kind of a major theme for the year? Let's assume for a minute it is a major theme for the year, where the hyperscalers kind of cool off a bit, but the other parts of the market catch fire. Can the market still be up like 15% plus without the hyperscalers, given how big of a chunk of the market share of the indices they are?
No, because the small cap, mid cap stocks in particular, they don't make up that. If you think about where the major assets are held, right, it's mostly in large cap equities. Think about your largest ETFs, stock market, the Vanguard Total Stock Market, the SPY, the VOOs. That's where the bulk of the assets are held. So and again, since those are primarily made up of the large cap stocks, particularly the kind of these hyperscalers that make up a big percentage of that, it'll be very difficult for the overall market to be up that much if you don't have those guys kind of pulling the horse, so to speak. I mean, financials make up a big part of the market. Healthcare makes up a big part of the market. So again, if those guys do better, then a positive return year will be we'll have a good positive return year. We'll be up 8, 9, 10% this year. I think it'll be difficult to gen out another 20% return without the big mega caps driving the lead.
Okay. Now, on an individual basis, you could create a portfolio that has a lot of exposure to these other industries and these
Sure.
different cap sites, and you could have a great year, right? But I hear you saying, and this is the math I was chewing on, it's going to be hard just for the overall indices to perform as they have in the past 3 years if the hyperscalers cool off.
Right. And again, I'm not sure that that's the case, that's going to be the case. If I was a betting man and saying, okay, what do you think is going to happen over the next, 6 months to a year? When I look at the fact that you have emerging markets, small caps, micro caps, small cap growth, dividend developed markets, all shoved in this upper right-hand corner, there's not a lot of gain to be taken out of these yet. There's not a lot of gain to go. In other words, these things are so extended and so deviated from means, you're going to get a rotation, and that rotation, ironically, would be into the most oversold sectors, which are mega cap growth and buyback achievers,
Yeah.
because those are the ones that have been under the most pressure.
Okay. So
Right.
we could return to our regular programming, is what you're saying.
Yeah. So again, look, I have no idea if that's going to indeed be the case. But again, knowing how sector rotations work, and again, so a good example of this, you and I were talking last October, and we said, hey, we're buying some healthcare stocks because they're really beaten up. Nobody likes healthcare right now, and tech is really overbought. So we reduced our tech and bought healthcare. They did great through the end of the year. Earlier and very early in this year, I told you that we were shifting a little bit out of growth and buying value in staples, and staples have done fantastic over the last couple of weeks. So these rotations happen all the time in the market, and this is why it's
Right.
important to pay attention to them. because it'll help you identify risk sooner than later so that you can make so you can take advantage of what's out of favor and start buying stuff that's in favor. And a good example of this, financials have been under a lot of pressure over the last, couple of weeks in particular. Let me light these up. There we go. Transportation has been running with that small cap trade, very overbought. Energy's been doing great. Part of that small cap trade, very overbought. Materials, same way. This is that economic reflation story at work. These are extremely deviated from their long-term means. And again, financials now, utilities, real estate, technology are more of the oversold camp. So again, this is where I'd be looking at maybe buying some financials, maybe buy some, kind of value growth, uh, and kind of look at maybe taking some profits out of my kind
Wait,
of
wait, wait. What's
economic growth
value
cycle.
growth?
Sorry?
What's value growth?
No, value and growth.
Oh, value and growth. Okay.
Not well. And look, here's a kind of an interesting stat for you, right? Nvidia is a value stock. It's if you take a look at Nvidia, right?
If you look at it on a price to growth basis, is that what you're talking about?
Yeah, it trades at a 0.49 price to growth. Even
Yeah.
their forward PE is 24, right? This is not an overvalued stock by any stretch of the imagination, not given the rate of growth of their earnings, right? So, I mean, that's what I'm saying. So there is an argument to be made for a quote unquote value growth stock. Those do exist, but and specifically what I'm talking about is building a portfolio that has some growth components to it because if markets do well, they'll do well, but also add some value for protection.
Okay. Hey, and folks, he just hopped off it, but the charts that Lance was going through earlier were from RAA's Simple Visor service.
Right.
Fantastic service as we've talked about in the past, but during the conference last weekend, one of the members of Lance's team actually kind of did a real deep dive and walking through a lot of the powerful tools that are in there. It is such a phenomenal tool that you guys have built
Yeah.
there, Lance.
Oh wait, I'm
Um,
so excited too because we're very close to launching the new version, which is got AI integrated into it, and it's really really cool. So I'm really excited about that.
all right, and I'm still not entirely sure what that means, but when it launches, we'll let you walk everybody through it
There you
here.
go, no problem. Yeah,
Okay.
it just basically says that it's smarter than I am. So,
Well,
by the
I
way,
mean,
which doesn't take a lot.
I was gonna say, how high is that bar, brother?
That
Yeah,
bar is
exactly.
pretty low, Adam. Pretty low.
All right, look, still some more topics I want to bang through. We're going to have to
Wait,
start to get to kind of lightning round here. Um, so you made a case that if things get rocky in the markets, uh, because everything has gone up pretty much, capital is going to rotate into assets that are unloved right now, like treasuries. But in the interim, given all of the drama that's been going on, particularly with tariffs in Greenland and
yep.
Trump going over to Davos and kind of reading the riot act to all the Europeans on their home turf. Um, we've seen bond yields rising, especially as Europe has, puffed up its chest and people have said, "Well, we're going to stop buying your treasuries, America," and that's already happened with a
So glad
few.
you brought that story up.
Yeah. So anyway,
That's an hysterical story, by the way. We'll talk about it.
okay. I just want to give you a chance to speak to the rising bond yields.
Well, they haven't risen. You had that they
Well,
moved.
I mean, come on, they have a little bit. They were close to
Oh,
4 and now we're 4.2 or whatever.
yeah, you're at 4 point.
2
Let's see.
plus.
Today you're running yields at. Wait, hold on a second. I just looked at this a second ago. Your yield's 4.25. I mean, you've been hovering around, 4.1 to 4.3. This isn't, yields have been stuck here for a while, but again, there was kind of a knee-jerk reaction to the announcement that this Denmark pension fund was going to sell their treasuries in response to this whole issue over Greenland, which was laughable because they own $100 million worth of treasuries. Just as comparison,
Which is what, like 10 minutes worth of buying or something?
well, just a comparison, my firm, we own near 300 million in treasuries because we have 2 billion under management.
Right,
So,
right, right. And
and
you're a
so
60/40 firm, so you've got
yeah,
to.
yeah, yeah. So, we have almost 300 million in treasuries. So, but even with that, I'm going to make a statement tomorrow morning. We're going to sell, we're not, okay. Just if you're a client watching this, we're not going to do this. But I can make the statement tomorrow morning, we're going to sell all of our treasuries in response to this action. It would not even move the market. There's a pension fund sitting there going, yeah, I'll take all that you
Yeah,
got, give it to me now.
yeah.
I'll
Have
take
any
it.
more?
Yeah. The latest bond auctions went off with a dramatic increase in foreign demand. Foreign demand of owned treasuries now are at an all-time record. But importantly, Europe saying, yeah, Europe's great because I always say this stuff that's complete nonsense. First of all, most of the treasury bonds in Europe are owned by individuals, institutions, those type of things. They're not owned by the central banks. And so trying to get a coordinated effort of that would be near impossible to get them to dump their treasuries. But secondly, it's nuclear death for them
Right.
because again, their whole trade system is based on the US dollar. And so if you go dump all your treasuries, you have to eliminate all your reserve currency. You've now completely screwed yourself. So these narratives are hysterical. They make great for headlines. And everybody kind of reacts to them, but again, just the reality of it is so laughable that it was funny that anybody even paid attention to it.
Yeah. Well, and it also just begs the question, okay, you don't want America's debt, all right? Whose debt are you going to
Yeah,
hold,
where
right?
are you going to put your reserve currency now? Yes.
Yeah. And look, I'm not saying that to sound like um, a braggadocious American, but it really is. At some point, it's just like, look, the next alternative has a lot of issues along with it.
Oh, I did an interview. It's going to air on Monday with a guy named Parker White. He's the chief officer for DeFi development. You heard Daniel Kang over the weekend at the summit. This is his partner. But we just did a deep dive into stable value coins or
Hmm.
stable coins
Stablecoins.
and the impact that is going to have because all of those stable coins are basically going to be using treasuries to peg to the dollar, which is another, and as those stable coins gain traction for immediacy of payments, et cetera, that's just increasing the rate of demand for US treasuries, which is going to require all these other countries to own even more treasuries to maintain these stable coin transactions. So this is going to be stable coins. And again, the more I got in that conversation with him, it really was fascinating because I knew that was going to be important. I had no idea how big that's going to potentially be.
So folks should definitely go listen to Lance's interview there. But Lance, I think we talked after I'd interviewed Brent Johnson back in November about this, and it was so mind expanding when you
Yeah.
really start peeling the onion there, and it really all this concern about de-dollarization in the world. It's hard once you understand stable coins not to see re-dollarization
Mhm.
as an inevitability here. So, anyways, folks, watch that interview with Lance, and then if you haven't watched the one I did with Brent, highly recommend you go watch that one as well.
And by the way, if you ever want somebody to talk more about it, I'll hook you up with Parker. He's really, really well spoken, very, very knowledgeable on the whole crypto space, how it works. So yeah, it was a good interview though.
Well, thanks, and
I learned a lot.
I'll
So
definitely watch it. Okay, so bond yields, you're kind of like, nah, not a big deal, at least not at this point. Okay, so a couple other quick things. Want to get your quick thoughts on what's going on with oil and gas. They're having quite a strong start to the year.
mhm.
Natural gas has had a week for the ages.
Yeah.
I think it's up like 30+% on the week, which is huge for a commodity. Um, just a quick promo here too. So this video is coming out on Saturday, Lance, the day after Sunday. I'll be releasing an interview I just recorded with Rick Rule. That's a deep dive in the oil and gas industry. And I'll just say, folks, that Rick, I asked him, on a scale of 1 to 10, given your long career, Rick, and your many different successes with identifying, getting in early on a big trend,
Mhm.
how are you looking at the oil and gas opportunity right now, given their current valuations and given where you think the value of the sector could go? And Rick's answer was a 1. And for a minute, I thought, really? I thought you were excited about this. And he said, oh, I thought 1 was the best.
Oh.
Um, so he goes into a lot of
Depends on your
details.
scale.
Yeah, exactly. So he goes in a lot of detail with that. But when a guy like him, who has made so much money from basically riding repricings of major commodities, says, I think this is one of the best opportunities I've seen in my career, we really should pay attention.
Yeah.
So, anyways, you and I have talked a bit over the recent months about how this is looking like an attractive time to start building positions in oil and gas. And I know that you guys have some core positions anyways at RIA. But we've talked about maybe you guys might start increasing your positions and whatnot. What do you think? How are you feeling about what you're seeing so far in the performance of oil and gas so far this year?
Great. I mean, we just launched recently an entire energy-centric portfolio that's already up 6% for the year. And we literally just launched this thing like 4 weeks ago. So it's doing really, really well, outperforming the market. But again, yeah, I still think there's risk to the oil market this year. If the economy slows down, if
Sure.
there's a lot of ifs, right? But I think you're going to see little spurts in oil, right? I mean, things are going to happen. Like natural gas went up 30% in a week because we're all going to die of frostbite over the weekend.
Yeah. But
Um,
by the way, my little brother lives in Wisconsin. He just texted me. It is the weather thing said it's like -15, but feels like -38. I mean,
yeah,
that is god awful cold.
yeah, and it's going to be we're going to be you know freezing here over the weekend in Houston. It's supposed to be in the 20s this weekend. I know for a lot of people, it's like, in South Dakota, they're going to be in the 20s. They
Yeah,
have
I
to beach
know.
weather, but for Houstonites, that's pretty damn cold here. So, but, so yeah, not surprising natural gas spike. You're going to have that kind of stuff with oil going on as well. Oil has a lot of seasonality to it. Hurricane season is a good example as we get further into summer. But so I think oil, my base case outlook is that oil is going to struggle a little bit, maybe this year, unless something happens. But if we get something like peace in the Middle East, and all of a sudden we get a lot of reserves released into the market, that's going to suppress oil prices. So I think you need to watch.
Right. Or peace in Ukraine too.
Right, yeah. I think you need to watch those type of events, but I do think longer term, and again, we've got some core positions as we discussed at the conference on that kind of the behind the meter play on the power gen side of oil and gas. But I do think there's a place as we get through this year for companies like an ExxonMobil or a Diamondback Drilling or a Schlumberger, those type of things, which those companies will do well and probably continue to do well. Plus, you get a
Okay.
nice dividend from these companies as well.
Well, so that's exactly it. So Rick, I think, wouldn't disagree with you, Lance, where he thinks it could take a year or two, maybe even 3 years for this sort of repricing that he expects to
Mhm.
happen to occur. And I'll say I'm actually hoping that oil goes down this year because I'm kind of on a dollar cost averaging program
Right.
right now. And I would love to be buying over the next year at lower and lower prices here as I build my positions. But I asked Rick this, and he said, "Yeah, it's absolutely great." He said, I said, "Look, versus a number of the other things that you got in early on. So, like Rick was very big on uranium several years before it took off, right? And he was beating the table, saying, 'Look, folks, I don't know when this is going to go, but when it goes, it's going to go big.'" He was exactly right. But during those years where he was in and waiting, he's just eating the opportunity cost of the capital he has invested in there. Where here in the oil and gas space, you actually
Mhm.
get pretty attractive dividends. So,
Yep.
he's basically saying like there kind of almost is no opportunity cost to capital. And so, that's getting subsidized by the dividends. And then, if the
Mhm.
thesis is correct and the price then pops, like, it works doubly well for you. So,
Yeah, absolutely. No, and look, we're big advocates. We run two different types of dividend models. We run a pure dividend model, and we have a dividend growth model, which combines growth stocks with dividend stocks. But when we're even in our standard core portfolios, we have positions that yield dividends because again, when you think about investing, you should always factor your portfolio on kind of a three-legged stool. And the biggest mistake that investors make is they start focusing on one aspect of their portfolios, like I'm all in growth stocks, which is fine, but now you're solely tied to capital appreciation. Your stool, your portfolio should have three legs to it. Dividend income from stocks that you own. So
mhm.
that's an income stream that you're going to get. Interest income from bonds, because bonds protect your capital and provide an interest payment into your portfolio. So you're constantly getting cash flow coming in, which can then be reinvested into other stuff. And then have your capital appreciation component. So all three of those give you a nice total return structure for your portfolio that will not only lower volatility of the portfolio, but in periods of sideways markets or down markets, you're still accumulating cash because of all of that income that's coming in. So it's always helping the portfolio grow, stabilize, maintain itself, and gives you cash flow to reinvest. It's always fascinating to me. It's like people go, well, you should just buy and hold the markets and then dollar cost average on the way down. Sounds great. Except if I'm buying and holding, that means I'm fully invested into these ETFs. And so when the market's declining, I've got no money to invest, right? I never
Right.
get profits. Well, what dividend and income gives you is the ability to reinvest capital all the time back into your portfolio. So,
Yeah.
so yeah, we're really big advocates on dividend. It's such an important function of the portfolio over time.
Yeah, and I got to say on that, as I have built my wealth over time, like most early investors, I had a very equity capital appreciation mindset.
Mhm.
And once I started working with a financial, and I would write things up and write things down. Um, Once I started working with a professional financial advisor, and I sat down with them and they really tried to understand what kind of investor I was, and they were like, "Whoa, yeah, all right, you're actually a pretty conservative guy." Um, so, let's make sure that we have a good income, sort of conservative income part of your portfolio.
Mhm.
I got to say, as the years have gone on, God, do I love just logging into my account and just seeing it go up because the income checks just keep coming in. And of course,
Yeah.
as your wealth builds over time, those income streams get bigger and bigger, right?
Yeah.
And you
Yeah.
don't have the huge varieties that you had before. It's just for a guy like me, it's great just to see a steady Eddie improvement. Yeah.
No, absolutely. And look, I love the stock market. And I'm like you, when I was younger, I was all about the stock market, right? So all my money was invested in stocks and blah, blah, blah. And now that I'm older, I've shifted a big chunk of my money to assets that generate me 10 to 12% a year, every single year, and just create that with no volatility risk, right? So I've got, I do a lot of
Lance,
private
you're going to
those
get
type of
so
things.
many emails after this of people saying, "Wait a minute, where can I get this no
Yeah, yeah.
volatility 10 to 12% return?" Yeah.
Well, again, but I do hard money lending and I know how to do it. So, I have other firms that I work with that also do hard money lending. But I mean, it's a complex process, but I've built this ability to create these 10 to 12% rates of return. And so if the market goes up 20, great, I don't care, right? If the markets go down 20, great, I don't care. I get checks every single month. And it changed my outlook about investing in markets over time because once you can become okay with just having cash flow, all of a sudden the risk profile that you need to take to generate wealth drops dramatically. And
Hmm.
once you can get yourself away from chasing markets to build well, again, one of the worst things that we ever did to individuals, particularly younger kids these days, is televise everything, right? It's like, the market's up today, this is happening. And so we benchmarked everybody against this index that goes up and down every day and just turn the markets into a casino. And that kind of erodes the real ability and the real fact about investing capital, which is to make it grow steadily over time. And so once you can get to that mindset that if I can create enough inflow that I don't have to worry about anything else, life becomes really easy after that.
All right. Well, look, folks, especially if you are older, income becomes a really important part of your life too. If all this stuff sounds attractive to you and you don't feel like your portfolio is set up optimally the way you'd like, and you want to talk more about the potential of things like income or making sure at least the three stools of your portfolio are working together in unison, go talk to your financial advisor or go talk to Lance and his team. And of course, I'll tell you how to do that in just a second. All right, Lance, I'm going to punt the rant for today just because we're getting long
But just
here.
tell me the topic so I can be prepared for next week.
It's one you're gonna like. There's a fitness element to it. Don't worry, you're gonna react to it just fine.
Okay.
Um, but real
Keep me in
quick,
suspense.
we're gonna get to your trades real quick. But
Huh?
before we do, I just want to put up the bad idea of the week. All right, and I'm just gonna read this headline to you. You may soon be able to use a buy now, pay later plan for your rent.
Jesus.
Yeah.
This, this right here is why the youth is basically destined to fail.
Mhm.
This is terrible advice.
Oh, it's the worst advice. It really is just the worst advice. It's going to create a whole, generation of lifetime debt slaves, debt serfs.
Yep.
Again, you and I have said this is the most obvious future headline we're going to see, which is, catastrophic losses in the buy now, pay later space. Whoever could have seen this coming? And we're just
Right.
going to be raising our hands saying, us and probably
Yeah,
almost
yeah,
everybody else with two neurons. Yeah.
exactly. Yeah, I
But
know
you talk, you talk, you
it's
talk about
always
how creative, consumers are when times get tough, that they can still find money to keep their spending going. They can, and part of that is you know, a positive attribute of the creativity of human beings, but a huge part of that as well is whatever you want to say, a massive uh, condemnation of the evils of the industry that will sell these people the rope to hang themselves with.
exactly. No, it is. And unfortunately, it's just, again, this goes back to our whole conversation at the beginning of the show, talking about financial education. you know, we shouldn't even be offering this stuff out to people. This shouldn't even be an option. And, but we did this with subprime mortgages. We did, we've done it. Why do we have a housing problem? Because you did subprime mortgages. You can trace it all back to, zero interest rates, subprime mortgages, all this type of stuff that we did to let people buy stuff that they shouldn't be buying. And, we keep doing it. And then we wonder, and again, to your point, then when it all blows up, everybody goes, well, nobody could have seen that coming.
Right.
It's not hard to see it coming, right?
Right.
But
And then, by the way, we need to bail them out. It's like, why? We
why?
all could see that this was going to be the end case.
Exactly.
And you know what's so interesting to me too, Lance, is like we the regulators stepped in front of the five-time leverage ETFs,
Finally.
right? And I think they should have. I applaud that, right? But all right, if you've got money to be investing and you feel like you're sophisticated enough to take the risk of a five-time ETF and it blows up on you, you know what? I mean, that was a risk that you largely took with your eyes wide open. Yes, there will be novice investors who get burned on that, right? And again, that's why I think they should have stepped in. But that's a class of people who's not necessarily in dire straits right now. The people who are turning to buy now, pay later to do things like DoorDash or pay their rent are people in dire straits right now. How come the regulators aren't lying in front of that? That you're going to help a lot more people who need it
Correct.
more with that, right?
Yeah. I mean, this is why the whole what was the whole organization we put together, the financial
The Consumer
consumer
Finance
protection
Protection Bureau?
division.
Yeah.
Yeah. I mean, that's their job. They should be looking at that going, that is not good for consumers. Look, we shouldn't have to put guardrails on consumers. We shouldn't have to tell you what to buy or not to buy or how to save, but apparently we do. So maybe
I'll bet
we
you if we
need a
looked at the
consumer
Congress people
protection
who were
division
involved in creating that, they're getting big checks from companies like Affirm.
exactly,
Yeah.
exactly. So
All
anyway,
right. Well, look, that
another
wasn't
rant
the
for another
rant,
day.
but I knew that would trigger you a little bit.
Yeah, next week we'll get into that.
Okay. All right. So trades. What trades have
Uh,
you guys made over the past week?
the only trades we did were just basically yesterday. We just took our positions in silver and gold back to target weights. We've done this like 3 times
I
this year.
know. Yeah.
They get like extremely overweight in the portfolio. We trim them back to target. And we've been kind of watching Bitcoin here lately, and just on a weekly basis, Bitcoin's getting extremely oversold, getting to start to see a little bit of a technical recovery, and we're not on a buy signal yet, but starting to approach that on a weekly basis. And historically, when we've seen these types of signals occur, it's been a pretty decent little run, probably 20-25%. So
Mhm.
we just started taking, as we were saying earlier, right? If you take profits in silver, what are you going to do with it? Just let it sit in cash? No, we're looking for opportunities elsewhere that haven't come yet. And I think at some point people are going to go, you know what? Bitcoin's really kind of been beaten up here lately. I think there's going to be some opportunity there, and
Mhm.
at least you get some buying interest here for the near term, just a rotational basis. So that's what we did this week.
All right. So let's try to talk a little bit about that next week.
Sure.
It sounds like you haven't bought yet. You're just watching
No,
closely
no,
at this
we
point,
did.
right?
We bought a so our portfolio weight in Bitcoin could go up to 5%. So we're at 2% right now.
You're at 2%. What were you at before you bought in?
Zero.
Zero. Okay. All
Yeah.
right. So you've made an entry position in it. When we talk next week, I also want to ask you about MicroStrategy, because I was actually talking to my wife this morning. We were
Mhm.
looking at the portfolio, and I said, look, the one thing that's really not doing well is MicroStrategy, which is down over 50% from where we bought it.
Right.
I actually didn't buy much at all. It was a little just sort of toe in there because I don't have much Bitcoin exposure, and I'm thinking about maybe
Right.
taking some profits from silver and putting it into that for exactly the reasons you're talking about. But we'll get into that
We
more
will, and
next
I'll
week.
tell you why not to do MicroStrategy, but we'll talk about that next week.
Well, and that's why I want to talk with MicroStrategy, because there is a leverage going
Mhm.
on there, and one may argue, well, hey, when Bitcoin goes back into their upcycle, MicroStrategy might go to the moon. So I want to hear your thoughts on whether that may or may not happen.
Sure.
Okay, all right, folks. Well, look, if you think that the fastest way that you could send your personal prosperity to the moon is to continue to watch Lance Roberts on this channel week in and week out, please let him know that by hitting the like button and then clicking on the subscribe button as well as that little bell icon right next to it. Just a reminder, if you would like to get some help from a personal financial advisor for all the reasons that we've already talked about here, if you don't already have a good one advising you, consider talking to one of the ones that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. Perhaps you'd like to talk to Lance himself and his team there at RIA. To do that, just fill out the very short form at thoughtfulmoney.com, and the advisors will be in touch with you very quickly after you do that. Folks, I'm going to give you a couple of other links here too. Uh, so Lance just had his conference. The Thoughtful Money Spring Conference is now fully planned out. It's going to be Saturday, March 21st. I haven't kicked off the marketing for that yet, but that's going to start happening really quickly. So for those of you that are signed up for our newsletter on our Substack, keep your eyes out for that. I will just mention though, the faculty gets better every year. This year it's amazing. I'll give you the full list in a little bit when we kick off the marketing, but it'll be kicked off by Lacey Hunt, as always. We've got Matt Taibbi joining us this year. We've got Ed Dowd joining us this year for the first time. We're going to have Rick Rule come on and really open his kimono on not just all the oil and gas stocks that he likes, but a number of other commodities as well. There's a whole bunch of other folks as well, but I'll keep you in suspense for those until we do the official announcement. But if you want to lock in your ticket at last year's prices, I'm not sure yet whether we're going to be able to keep them flat or whether we're going to have to raise them a little bit for the spring. But if you want to buy them now at what the price was last year, you can go to thoughtfulmoney.com/2026 and you can buy your ticket for the spring conference there at a 0% inflation rate. Last thing is, silver, who knows what's going to happen? And I just talked about how if you've got a lot of it and you're sitting on big gains, you should protect them. But if you haven't been in and you want to either create your initial exposure, or if you think silver's still got a fair amount of road to run here, we just want to remind folks that the promotion that Andy Schechtman of Miles Franklin, Thoughtful Money's precious metals solution, indoor solution, he still has supplies that he is making available to this audience to buy junk silver at just 99 cents above spot price. And Andy has said this is one of the lowest premiums he's ever seen in his career. So if you want to take advantage of that, or just talk to Andy and his firm about any other precious metals needs you may have for buying, storing, or selling, just go to thoughtfulmoney.com/buy gold and fill out the short form there, and Andy and his team will be in touch with you right away. Speaking of buy gold, Lance, gold is now, what's that? Just $15.17 away from the big round number of $5,000 gold. So maybe we'll talk about that next week too.
Yeah, no, we'll get there. I mean, markets love round numbers. So 5,000 gold, 7,000 S&P. Yeah, markets love it.
Markets love it. All right. Well, thank you, my friend. Another great week. Again, really wonderful to see you in person, and
Absolutely.
congrats on a great event.
Thank you so much. I'll see you soon.
All right. Everybody else, thanks so much for watching.
Both when you measure silver relative to gold in the bull markets, like 1979, 80, or 2010, 11, silver versus gold was up in the 3.5% to 6% range price of gold. Well, that would mean relative tripling to get to the old bull highs on the spread. Let's say the 3+%. So, we're at right now well above 1%, but you get up to 3%. That would mean, well, I throw this number out a lot, and it's not a projection. I think you'll go way past it. But gold has had two bull markets in the last 50 years where it's gone up ninefold. Okay, if you go up ninefold this time, it means you're going to $8,500 gold, because our low is 1,050. Right. So a ninefold move from 2015 to, that's just replicating what you've done twice before. The circumstances this time are far more monstrous. terms of driving it much higher. The monetary crisis we'll face, the government debt crisis. So stopping at 8,000 is highly unlikely. But even if you went to 8,000, do a tripling of silver relative to gold, silver would be at $240.
In past bull markets, silver traded at 3 to 6% of gold's price versus just over 1% today, highlighting major upside if it reverts to historical norms. While gold reaching $8,500 is only a bullish scenario, at a 3% ratio, silver could be around $240. With rising industrial demand, persistent supply deficits, and mounting global debt pressures, silver is viewed as deeply undervalued, reinforced by the elevated gold-to-silver ratio above 90 to 1 compared to its long-term 40 to 70 average. Michael Oliver, veteran market analyst and the founder of Momentum Structural Analysis, highlights that silver is experiencing its largest demand surge in decades, especially in solar, electronics, AI, and defense sectors. Meanwhile, supply is shrinking due to declining mine output and inadequate recycling. MarketWatch describes this as a potential supercycle, with severe supply deficits encouraging a powerful, bullish run. Noting this, Michael Oliver predicts that silver is entering an acceleration phase and could reach $60 to $70 by year-end, surpassing its old highs near $50 from 1980 and 2011. Adjusted for money supply growth and inflation, silver would need to be around $200 today to equal those past highs in real terms. They believe this surge will break well beyond those outdated levels. Silver has broken through long-term resistance at $34.90, surging to $38 to $39, its highest in 13 years, signaling an incredible breakout, with technical targets of $41 to $42 and potential for a larger structural rally. While silver has jumped approximately 54% from $24 this year, mining stocks remain undervalued, attracting institutional and ETF inflows. With industrial demand from solar, electronics, AI, and defense rising against tightening supply and reported deficits, the outlook remains strongly bullish. In order to receive fast notifications whenever we release a new video, please like this video, subscribe to our channel, and turn on the notification bell.
Yeah, they've already done that, frankly. Silver had a high back in October of last year at 35. It dropped. Came back up in March of this year, hit 35 again, dropped. In fact, it had a cleansing drop down to 27.50. And then came back up, and in June, it got up above 34 again. Again, not taking out the 35 plus highs. Okay, they were like 35.50 each. But at 34.90 area, we had a major momentum breakout of a structure that said, okay, silver's coming out of this congestion. By congestion, I mean, if you go back to May of last year, silver was 32.70 at a high. You could draw a line sideways through May of this year, where it was either side of that level, up and down, but really just net sideways. When it got back to 34.90 in late June, we said, that's it, it's coming out of here. Whoosh, it went up to 39. Now, as typical, the price chart guys like to sell round numbers or just in front of them. So let's risk 40, okay? Okay, and now we're trading either side of 39 right now on the September contract. We think the process has already begun that you were asking about. We think the acceleration phase in silver and the miners. Now, for instance, GDX has gone from a sleepy upside pattern to suddenly it's now up to near its 2011 highs. We expect GDX not to even stop until it clears its 2011 highs, meaning get up in the upper 60s. And same with the miners in general. Silver, we think in this move, in this acceleration phase for it and it relative to gold, is likely by the end of the year to see $60 to $70. Meaning those old antique highs at 50 in 1980 and 2011, which are really sort of jokes. Because one, you were up there very briefly, like days, and back down. And when you do a real valuation, the degradation of the money unit since 1980, the increase in the M2, or since 2011 even, heck, gold would probably have to, silver would have to be $200 now to just match in real value terms those price highs we saw then. So it's catching up. And I think this surge will blow past those, what we call idiot highs. And at that point, what's going to happen? The public's going to say, oh my gosh, I missed this. I got to be in it. And so I think that's when you're going to see an onrush, fairly fresh, of money moving out of the doubting stock market into, hey, I missed this. I got to be in it. The gold, silver miners and silver. And that's when you get this gush effect. The wet bar soap effect, where everybody's grabbing it goes up. This is not unusual in markets anyway, but especially in these situations, I think I think we're in process right now, in other words.
So when we consider that type of move, Michael, do you see this as more of a different type of new high? As you said, this was kind of a silly joke of a high, up to $50 and instantly back down. Do you see this as a possibility of being a more sustained type of new price level for these metals?
Yeah, and both when you measure silver relative to gold in the bull markets, like 1979, 80, or 2010, 11, silver versus gold was up in the 3.5% to 6% range price of gold. Well, that would mean relative tripling to get to the old bull highs on the spread. Let's say the 3+%. So, we're not right now well above 1%, but you get up to 3%. That would mean, well, I throw this number out a lot, and it's not a projection. I think you'll go way past it. But gold has had two bull markets in the last 50 years where it's gone up ninefold. Okay, if you go up ninefold this time, it means you're going to $8,500 gold, because our low is $1,050. Right. So a ninefold move from 2015 to, that's just replicating what you've done twice before. The circumstances this time are far more monstrous in terms of driving it much higher. The monetary crisis we'll face, the government debt crisis. So stopping at 8,000 is highly unlikely. But even if you went to 8,000, do a tripling of silver relative gold, silver would be at $240. Is that about right? So it's the point being, when we go up there this time, also the events in the world and in the street events, the academic notions about what works, what doesn't.
Michael also compares silver with gold in a way that he points out that silver has a history of outperforming gold during strong rallies, like in 2020, when silver nearly doubled while gold rose only about 25 to 30%. Recently, the silver-to-gold ratio fell below 1%, meaning silver was priced at just 1% of gold's value, a rare level that historically signals a strong buying opportunity. Over the past few months, silver has started to outperform again, while gold has mostly moved sideways, showing strength that suggests it's entering a new phase of outperformance. Looking at long-term trends, silver often reaches around 2% of gold's price, so doubling in relative value, while gold itself looks ready to resume its upward move soon. The best opportunities right now appear to be in silver and mining stocks, with gold likely to follow later.
That's the growth. Also, state and local government was a huge component the last time around. And usually government hiring has been a huge thing for the last 6 months. And when you look at things like transportation or factory, flat to dead, if not declining. But the overall number looks great, okay? So it's all illusory stuff. And he finally admitted to it. That's great. So anyway.
So, Michael, we've talked a lot about gold and its reaction here. Do you think we should be thinking any differently about silver's reaction, despite the setup for gold with the, interest rates and the equity markets that we've already touched on?
I think silver is participating with gold. It vastly outpaced gold in that 2020 rally. Silver almost doubled in price, whereas gold went up about $500, which is like 25%, 30% rally. Silver doubled. So into mid 2020, silver had outperformed gold on a percentage basis. But from 2020 through, well, the recent low, the silver spread went from like 1.5% of the price of gold down to 1% of the price of gold, even got below 1%. We divide an ounce into ounce and you find it was 1% of the price of gold. If you go back through 50 years of history and look at that spread relationship, you'll see that when you get down to the 1% level, it's time to buy silver. Okay, it's meaning it's dirt cheap. It's not going to go to zero versus gold. Okay, but then the technicals turned, and so over the last 4 or 5 months, you've seen silver outperform gold. Like for example, back in April, gold hit 3,500. It's gone sideways. April, May, June, July, now August. 4.5 months of comatose but steady sideways. They keep trying to sell it, but then go down. But it also doesn't go up. So it's had a sideways correction, which is, by the way, not the way gold ever tops. Okay. During that time, silver's gone up sharply. Okay. We assess technically that silver's now at a point where it's going to outperform gold fairly dramatically. If you go back over 50 years and look at that same spread, you'll see the number of years it got up to at least 2% of the price of gold was like 21 of those 50 years. So it's not abnormal at all. So from the recent low of 1% to 2%, meaning silver could double in relative value to gold, probably over the next year. Wouldn't be surprising me by the end of the year even. Same is true with the gold and silver miners. They're back into outperform mode versus gold. And if you'll look at gold sideways since April, look what GDX has done, vertical. Okay. So I think those parts of the monetary complex are the place to be right now. Silver, the gold and silver miners. Gold will re-engage, and I think it's going to re-engage probably later this month or next to the upside, where people say, oh, it's awake again. Mm-hmm. But silver and the miners will be the place to be.
Silver appears to be entering a powerful new bull phase, supported by historic undervaluation relative to gold, record industrial demand, tightening supply, and strong technical momentum. With prices breaking out to multi-year highs and miners still undervalued, analysts like Michael Oliver see silver leading the precious metals complex, potentially reaching levels far beyond its old peaks. This makes silver and mining stocks some of the most compelling opportunities in today's markets. If silver truly enters a super cycle, how high could prices realistically go beyond the $60 to $70 near-term targets? With mining stocks still undervalued, should investors focus more on physical silver or silver equities to capture the upside? Please leave a remark in the section below with your ideas. Please remember to subscribe to receive updates, and if you find this helpful content, kindly give it a thumbs up. We are grateful that you joined us on this journey.
Clearly in Asia, particularly in China, they view it as money. And of course the BRICS, and that's one of my biggest bullish factors for gold, is I saw the de-dollarization and countries moving away from the United States economically and from their currency as bullish for gold. So that would argue that I still think it has to go a lot higher over time. But I think a reasonable target of 4,000, I think it's been accumulated. It's still probably 12 to 24 months away before they officially come out and say, okay, this is how we're going to trade among ourselves. And part of that is going to be gold. People who are going to talk about, oh, the Hunt brothers, and once went to 50, well, to get back to that, you're right. It's almost going to have to trade at 200 for inflation. So what I have said, and it probably throws me into the silver bug camps completely, is that triple-digit price of silver is a legitimate target.
In Asia, especially China, gold is still seen as real money, and that perspective is spreading among BRICS nations as they move away from reliance on the US dollar. a trend that strongly supports higher gold prices. China's central bank continues buying gold. In August 2025, it purchased about 2 tons. BRICS nations are developing alternatives to dollar-based financial infrastructure, including digital payment systems and local currency trade. Gold is increasingly seen as a neutral reserve asset among these countries. Given these shifts, a long-term target of $4,000 for gold looks reasonable. Silver also has enormous potential. Adjusted for inflation, its 1980 peak near $50 would be closer to $200 today, making triple-digit silver a realistic and justified goal. Peter Grandich, a veteran market analyst and financial commentator, recalls that back in the 1970s and early 80s, few believed the Dow could ever reach 3,600, let alone 36,000, but history proved otherwise, just as today many doubt gold's ability to climb much higher. The reality is that fundamentals for gold have never been stronger. De-dollarization is accelerating across Asia and the global south, with central banks and retail investors boosting gold purchases and trade in local currencies rising. BRICS nations are building alternatives to dollar-based systems, and gold is increasingly viewed as a neutral reserve asset. China continues steady gold accumulation, though its reserves remain low compared to its economic size, leaving room for much more buying. Analysts expect this sustained demand to lift gold's floor higher, with BRICS discussions of gold-linked trade further supporting long-term price growth. BRICS nations are exploring dollar-free trade, with gold discussed as a potential benchmark or backing asset, though no unified gold-backed currency exists yet. Rising central bank demand, especially in Asia, is lifting gold's price floor, while silver also shows huge upside, with inflation-adjusted targets pointing to triple digits. As we start the video, don't forget to hit the bell icon and subscribe so you don't miss any updates. Please give us a thumbs up and leave a comment below if you enjoyed the article. We value your opinions.
For 13 years, the Dow only traded between 700 and 1,000. In fact, the very famous Business Week front page said equities are dead. Wall Street was extremely bearish. And an unknown young man came out of Gainesville, Georgia, named Robert Prechter Jr., with a philosophy and a technical analysis no one really knew of, Elliott wave theory, and said the Dow's going to 3,600. And they just prosecuted him to call him every name in the book. And then when the market took off, he became popular, and then he made a call about the crash in 87 along with me. And the perception was, how could it possibly go to 3,600, let alone a few decades later, 36,000 and more? So that same feeling's in gold right now. People, especially people that have been bullish and profiting from it, this 36, this is way out of line. Yeah, it's great. It give you all the reason, but how could it go a lot higher? It's not possible. You have to take that same philosophy. There's no reason it can't. In fact, I would argue it's not cheap anymore. Someone that was buying it at 1,300, seeing the tripling. But the fundamental argument for gold has never been better. We had at one time suppression by central banks who were offloading it. Now they're the biggest buyers. We had clearly not any society thinking it was money. Clearly in Asia, particularly in China, they view it as money. And of course the BRICS, and that's one of my biggest bullish factors for gold, is I saw the de-dollarization and countries moving away from the United States economically and from their currency as bullish for gold. So I think the more important way to answer your question is not talk about some of the general stuff or inflation or even against the stock market, is to admire how it's performed in an environment wasn't as conducive as it is now. So that would argue that I still think it has to go a lot higher over time, but I think a reasonable target of 4,000. And remember, when you're in all-time highs, other than a psychological number, there's no real resistance. So, pick 4,000. Yeah, that'll be a round number and so forth. And, Wall Street has treated gold like kryptonite. I think 0.5% of portfolios are assumed to have some exposure to gold. Can you imagine if people just went to 1 or 2%? It's still a very, very viable market for the long term. Well, I think it's going to play a significant role in the BRICS. They have not acquired all of this gold as a trade or personal investment. They certainly can't flip it to someone that's going to pay even more so they profit from it. I think it's been accumulated. It's still probably 12 to 24 months away before they officially come out and say, okay, this is how we're going to trade among ourselves. And part of that is going to be gold. I don't think there's a worldwide situation coming anytime soon, because I think things have to get a lot worse before people realize how messed up we been with fiat currencies. I do still think that one of the ways that they're only going to be able to sell treasury bonds, especially long dated ones, a year from now, because I'm a big believer that short rates can fall, but long rates are only going to go higher. I think that's going to find a way that the Trump administration could reprice its gold that it owns to whatever the current price is, and also introduce longer term 40 or 50-year bonds with some sort of gold backing in order to get people to buy it. I think that's going to be how difficult it's going to come for the United States to fund itself, while other world bond markets, as we speak, are imploding as well. 180, and it was profitable to treat it as the second class citizen to gold. But earlier this year, when it dipped under 30, when I looked at the fundamental argument, it was never stronger in the 41 years I've been involved. So I became a silver bug. And I also said it probably would lead gold for quite some time to come. And I think that's happening here. I think you make an excellent observation. People who are going to talk about, oh, the Hunt brothers and once went to 50, well, to get back to that, you're right. It's almost going to have to trade at 200 for inflation. So what I have said, and it probably throws me into the silver bug camps completely, is that triple digit price of silver is a legitimate target. First of all, it's not that much more than a double from here. It sounds like a lot because for a lot of years it was single digits, low price. But I think it has every reason to continue to rise with gold. And the competition for it, the stock market, I have to throw this in. I made a big change a couple of weeks ago. I was not in the stock market crash camp. My January forecast for our clients was the stock market was going to be either side of unchanged. I told people to avoid U.S. equities, get into world funds. I love the Chinese market. But a couple of weeks ago, stuff just screamed that we were very vulnerable to a hard fall or even a crash. And that has been competition to gold and silver, and also cryptocurrencies. And so a lessening of the bull move or an actual decline, as long as it's not a total crash, could only aid the gold and silver. You know how I know that, Jesse? I left the metals and mining industry as a main place of business for myself in 2013. I dipped myself back in 5 years ago when I got very aggressive in gold and mining stocks and all. But I'm hearing from people in the last few weeks that I haven't heard from 10 or 20 years. And saying, hey, I was looking up metals and I saw your name. I thought you left the business. And then, of course, the follow-up question is all the same. So what do you like? And I think we're just at that stage now where, other than that little audience that always confined ourselves to, we used to call ourselves the hard asset crowd. I don't think we say that anymore. It's being broadened out to generalists. And I think that's going to bode to help the metal prices higher.
Peter mentions that the mainstream U.S. financial media won't highlight gold and silver because of their ties to Wall Street. But once public demand grows, that will change. Major gold producers are already generating huge cash flow and could see much more interest as generalist investors notice their outperformance. The largest gold miners reported record free cash flows, revenues, and profits in Q2 2025. Margins are very strong. However, production has fallen for some majors. Juniors are expected to outperform seniors in this cycle due to high leverage and exposure in exploration and resource discovery. Established miners are expected to continue reporting strong cash flows, using capital for dividends, buybacks, and to shore up balance sheets. Despite strong gold price performance, analysts, including Peter, believe gold stocks are lagging and undervalued relative to gold itself. Analysts are watching for better leverage to gold, and many see additional upside as investor attention and valuations catch up. Let's dive into the interview.
Well, much of the mainstream financial media in the U.S. is tied to the hips of the financial service community. They're not going to write things go against it. They're advertisers, So I never expect them to be write glowing stories about that, because gold and silver have been treated like kryptonite since I've been in the business by the financial service industry. And I don't expect that to change until the public overrides that demand and says, hey, listen, I'm listening, or I got this neighbor and they're killing it, and you blah, yada, 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 yada. And so that's when I think the public will come to it. The mining stocks, even the exploration, and they're two different species, and I'll address them both. The mining stocks, as I said earlier, when I got originally sold some of my physical gold in the beginning of the year at 3,500 to buy the major gold producers, which greatly outperformed the performance of the physical gold, they have many quarters ahead of just unbelievable, legitimate printing money through free cash flow. And what will happen for them and what will keep that sustained for them is, as we peter out in the stock market here, and we're seeing a lot of companies now not meeting the low end earnings estimates, so they can always say they beat them. These generalist money managers are going to hear about these mining companies. Look at Newmont Mining. Maybe today, as you and I record, depending on if Palantir gets hit enough and Newmont is rising, it's going to be the best performing stock in the S&P 500. Right now, it's number 2. And so that means it's outperforming 498 other general equity stocks. And yet, I would tell you that if we looked at people's portfolio, not half of 1% have Newmont Mining in it. So there's still so much upside demand for mining shares, and they should do well. But where I went to, and it's the most riskiest and speculative end of it, and remember, Wall Street created the word speculating, so don't really call it what it really is, and that's gambling, where you have to be mentally and financially prepared to lose part of all your capital. But the juniors is really where we're going to see a really bang for the buck. We're already seeing that in some incidents. And the reason is the world has not only shrunk to where companies can go and without too much risk and try to find the metals that are so critically needed now, everybody realizes, but the amount of money that has not gone into that industry to find these things. And remember, even if you hit it tomorrow, that you just went to a rock and drilled and it doesn't work that way, it takes several years of exploration and all. It's probably anywhere minimum, depending where in the world, 10 to 15 years before it comes out and pours the first metal and all. So when that recognition is realized by everybody and everybody realizes how we're scrambling, a gentleman made a good point to me the other day, and it was Sam Lee, it's actually the largest stock that I own, North Isle Copper and Gold. And he was just on a trade mission for Canada to South Korea and Japan. And he made a very good point is, even though they're world renowned for producing so much of the stuff we need, technology stuff, appliances and all of that, their entire base of metals that they need is from outside their country. They don't have any real own supply of their own. So here we have the world is scrambling for critical minerals and all. There's not been a lot of money put in them. I think that's going to make exploration companies become darlings for a period of time. And the majors, their currency is so strong now because of their stock, they're not going to try organic growth. They're just going to go out and buy, because we're still seeing good deposits selling for as little as $20 an ounce with gold at 3,600 and going higher. So to answer your question, I'm sorry for being long-winded, but I just think the mining shares and the exploration stocks, their day in the sun to where everybody's seeing it hasn't even arrived yet.
Metals and miners are poised for a solid next run higher, with fundamentals stronger than ever. Will the formalization of a gold-linked trade system by BRICS eventually hasten the move away from the US dollar? Is it possible that cheap mining stocks may eventually overtake gold's performance and produce disproportionate returns in the upcoming cycle? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
Gold is becoming more expensive. It is the dollar which is losing its purchasing power versus gold. The price has been steadily moving upward over the last 2 years. And it breaks out, it surges 15%, it consolidates for another 3 or 4 months, breaks out, surges 15, 20%, consolidates for 3 or 4 months. This has happened 3 or 4 times now. And as most people know, it's been consolidated under 3,500 since about April or May. It's now broken out, and I think there's a rush of speculative interest because another 15%, if we keep the pattern going, takes us up to about $4,000 an ounce. I think the next move in this current move is probably to 43 and a half, 44. If I'm right about all this yield curve control, cutting of rates, all that jazz, I think next year is when you get to 50, or at least you finally break through.
Gold's rise isn't about it becoming more expensive. It's the dollar steadily losing value against it. For the past 2 years, gold has followed a pattern of breaking out, surging 15 to 20%, then consolidating for a few months before repeating the cycle. After holding under $3,500 since spring, it has now broken higher, and if the trend continues, the next leg could carry it toward $4,000 an ounce. Silver, meanwhile, looks set for a move toward $43 to $44 in the near term, and with expected rate cuts and yield curve control ahead, next year could be when it finally breaks through the long-standing $50 barrier. Craig Hemke is a longtime precious metals analyst and founder of the website TF Metals Report. He recalls that back in 2011, silver's sharp run from $38 to $48 in just 4 weeks wasn't a bubble, but the result of a commercial short squeeze. Speculators were long while commercials were heavily short, and when shorts had to cover, prices exploded. If commercials pile on new shorts, silver will likely grind higher in a slow, stair-step move. But if they start covering without heavy speculative buying yet, that could trigger a breakout, drawing in new money and creating a powerful rally. Silver tends to sit quietly for long stretches, but once momentum builds, FOMO quickly takes hold. The current move may aim for $43 to $44 before pulling back, but next year, with rate cuts and yield curve control likely, it could be the time silver finally smashes through $50. If it does, tests that level as support, and holds above it, then the market could truly take off. If silver breaks above $50, the real stress will likely show in London's physical market, not COMEX. With supply deficits, limited float, and heavy reliance on paper ETF instead of real bullion, a surge in demand could expose shortages and trigger major volatility. That's when silver could truly get spicy. As we play Craig Hemp's video, kindly click the like button, subscribe to our channel, and enable the notification bell to receive fast alerts whenever we post a new video. I appreciate your support. Have fun watching the video.
Crazy breakout camp just yet. I think it's an important time for people to be paying attention to what's going on internally with silver. In April of 2011, okay, so most people remember that, price went from 38 to 48 in about 4 weeks of that month, over the course of the month. And it was assumed, it was written up, and people look back, with revisionist history and make it sound like it was a big speculative bubble. What was actually going on, if you followed the Commitment of Traders report back then, was a commercial short squeeze. They had all these speculators that are long, all these commercials that are short, and they started having to cover shorts for, without going into all the details as to who was short and why and all that stuff. But you could just see it on the Commitment of Traders reports. And that's what took it from 38 to 48. I think, could we have a similar month now? Of course. But we want to be watching those Commitment of Traders reports, because it'll tell you a lot. If the commercial side of that equation is aggressively adding new shorts this month, okay, well, we're just in that kind of stair-step phase, of 2 steps forward and 1 step back. But if we start seeing a lot of commercial short covering without a lot of new speculative money yet, and that's what drives us, well, then, when we get that breakout of, top of the cup, then you get this big rush of speculative money that just catapults you further. Because silver's a lot like, and I'm sure I've used this metaphor before, it's like Newton's law inertia or motion or whatever it is. I took physics, but it was a long time ago. An object at rest remains at rest until a force is applied to it, right? Just sit there. My computer's right here, but if I push it, okay, all right, it'll remain at rest until a force. And that's kind of what silver's like. Silver just sit there, as we all know, and just do jack for a long period of time, even like not keeping up with gold because people are waiting. You're like, well, I'm not going to get involved in silver yet because it's just sitting there doing nothing. But then as it starts to get moving, then you get this kind of FOMO thing. Hey, we've seen this before. And so what will probably happen, I would not expect it to smash through the $48 to $50 all-time highs in the first try. That's generally not how it works. And so I wouldn't think we'd get there this year. You go up, we could go to, I think the next move is, in this current move, is probably to 43 and a half, 44, given the channel that we've been tracking higher. Pull back, maybe under certain conditions, we make another run later this year. I think it's in next year. If I'm right about all this yield curve control, cutting of rates, all that jazz, I think next year is when you get to 50, or at least you finally break through. You go up, tap it, find resistance, finally break through. Everybody goes crazy, and then it pulls back, tests that old resistance level for support. And if it finds the support and you stay above 50, and then start making new highs after that, well then, holy Toledo, then we could have some fun. And this all the stuff we've talked about all these years, Elijah, about how much silver is there really in the world? The supply deficit over the last 4 years. How much free float is there in London? How many ounces are levered? How many times supporting the derivative markets? All that stuff. If we set off on this, break through 50 and everybody starts getting excited and the banks don't want to fool around with it anymore because they don't have it, they don't want to deliver theirs out or whatever, things could really get spicy next year. I saw that stuff too last week. There were 9,000, I can't remember, 9,900 or something COMEX September silver contracts that were open and standing for delivery when that contract went off the board. And then it gets delivered against, you got to be 100% margin long covered so that you can take delivery if that you're long and somebody the short puts the silver to you. And historically that's a lot. But back in March and May, we were doing 15, 18,000 contracts. Okay, so it's not like, oh, wow, it's 10,000 in September, the system. No, it's not. No, not yet, at least. Okay, but it is a not insignificant amount. If we've already delivered almost all of those, that's 50 million ounces. I don't know if it ever actually leaves the COMEX or if it's still just this, oh, this month I'll take delivery, next month you take delivery stuff. So we'll keep an eye on that. I don't think that's where the stress is. To me, after kind of getting excited about that 15 years ago, I don't think that it's the COMEX where you'll see delivery stress. It's more likely in London. I'll give you this. I mean, you've seen over the years, Elijah, and I'm sure everybody listening has seen this, where like Stan Druckenmiller or Ray Dalio or whomever, some big hedge fund manager, they'll say, we want to own gold. And you're like, good. And then they buy the GLD, right? And you're like, well, what good is that? I mean, that gives you price exposure, but you don't really, you can't take delivery, Stan. You can't take delivery.
Craig Hemke explains that the dollar index is misleading, as it only compares the dollar to other weakening fiat currencies. While it appears stable, all major currencies are losing purchasing power together. Recently, talk of yield curve control has quickly gone mainstream, signaling that central banks may soon cap long-term rates to contain debt costs. The U.S. looks set to follow this path, echoing past strategies to manage high debt. If that happens, it would echo what the U.S. did after World War II, when debt-to-GDP ratios were similar. Back then, the Fed and Treasury worked together to hold rates down, effectively inflating away the debt with cheaper dollars in the future. We could see something similar soon, especially if Fed leadership changes. This would likely require massive new quantitative easing, with central banks buying and monetizing their own debt in a move resembling modern monetary theory. Such a shift would push real interest rates deep into negative territory, and that's extraordinarily bullish for gold and other precious metals as fiat currencies are steadily devalued.
The deception of the dollar index, because it just compares the US dollar versus all this other equally worthless fiat, right? And so the dollar over time, you pull up a 30-year price chart of the dollar index and it's, it's 100 and it goes up to 120 and down to 80 and it just stays basically the same. Well, that's because all the other fiat currencies are devaluing at the same rate. But I said, expect more rate cuts than what people are thinking are coming. And furthermore, don't be surprised if by December, the December FOMC meeting, the Fed isn't openly talking about yield curve control. And I mean, I wrote that like on New Year's Eve last year. There were nobody talking about yield curve control. But now, all of a sudden, here in late August and early September, it's like, oh yeah, yield curve control is coming, like everybody was predicting this 8 months ago. Yield curve control is coming. Whether it's globally, if all these central banks have to do that to control the long end of their curve, right, and control their interest costs. But I think you're definitely being told and warned that it's coming here in the US. And I think that's all part of what's driving gold too, because that would be extremely bullish news for gold. You'd be holding real interest rates sharply negative. I mean, the US has done this before, which is why I wrote about it in my pod. I even put a link in there in that macrocast, because coming out of World War II, when we had similar debt to GDP ratios, that's what they did. They kind of combined the Fed and the Treasury together. They did yield curve control, essentially to pay off the debts of yesterday with the cheaper money of tomorrow, right? Get it under control, grow your way out of it, which is what Besant keeps talking about now. Well, anyway, if you want to take the time, to connect the dots, I think they're telling you that's what's coming as soon as next year, once Powell gets replaced and everything else. And so if that's the case, they're going to be trying to cap the long end. It's going to involve a lot of new quantitative easing measures, central banks buying their own debt, monetizing, almost like a modern monetary theory move. Again, all of this is extraordinarily bullish for the precious metals in terms of devaluing the existing fiat currency.
Both gold and silver are flashing signals of major shifts ahead, fueled by monetary policy, debt dynamics, and the growing disconnect between paper markets and physical supply. If central banks resort to yield curve control and deeper monetary easing, precious metals could enter a new era of explosive gains, marking a turning point for investors who have been patiently watching these markets build momentum. Do you think central banks will be forced into yield curve control sooner rather than later? If silver finally breaks above $50, will physical shortages in London expose the true limits of supply? Leave a comment below with your opinions. We would be delighted to hear from you. Please remember to subscribe for more material, and give this video a thumbs up if you found it useful. We appreciate you joining us on this adventure.